amid a looming default deadline. Fed officials say the FOMC may keep the policy rate steady this month, but more hikes could follow. US equity futures are little changed, even as Europe points higher. Plus, on the 25th anniversary of the ECB's founding, we get the Eurozone's latest CPI readings amid signs that inflation is cooling.
We have a trilemma of actually good news, Tom, which is why when you're looking at the futures, we're seeing a higher start to the day with DAX futures gaining some 0.7%. We had some good manufacturing data from China. We averted a U.S. default. And of course, the Fed is now pausing a possible pause, actually, in interest rate hikes.
Yeah, as you say, a trio of factors that could lift sentiment, is lifting sentiment, at least when it comes to these futures. Europe looking set to break 3 straight days of declines on the back of some of those factors. The China data was interesting because it diverges from the official data that came out earlier this week. It was the Caixin survey of smaller private companies, and it did come in stronger than expected. The Spanish IBEX rallying right now about 1%, adding 87 points. The FTSE 100 also gaining 0.2%, as it looks much clearer now that that debt deal will get done. It's unlikely, it seems, for the analysis in DC that there will be any major stumbling blocks in the Senate. But of course, there are the usual caveats. It has to get to the president's desk after this process. The FTSE 100 now adding 17 points. The CAC current over in France gaining 0.6%. Let's switch it over and see how things are shaping out across assets then. We're, of course, waiting for the inflation data across the Eurozone. As we mentioned in the headlines, the numbers coming through from the likes of France, Germany and Spain suggesting that there is easing now in these price pressures. So we watch that data out later today and what that means for the ECB. The euro remains at 106, so levels last seen in March. A little bit of pressure then for the single currency. It's flat today, but again, let's see how the inflation data informs the moves next for the single currency and, of course, the ECB. Futures in the US pointing to gains of about 0.1%. We had that pull down from NVIDIA. To what extent is that pointing to profit taking after that huge run-up that we've seen for the driver around tech, AI, semiconductors? The 443 is what you're seeing at the front end on the 2-year. Yields just edging up 3 basis points, and Brent gaining 0.7% along with iron ore, and the commodity space is getting a bit of a lift again from that slightly better than expected China data, $73 a barrel on Brent. Francine.
Tom, let's dig a little deeper into the sectors. So 20 groups making up the stock 600. All of them are rising, apart from 2, utilities and real estate, down 0.2%. But it's really basic resources leading the gains, probably on the back of that manufacturing data from China. I have media, retail, and construction on the way up, the biggest gainers overall.
Okay, so to the politics of DC then. The debt limit deal, as we mentioned, has cleared the House. It's a major step towards avoiding an historic US default. Lawmakers from both parties joined to approve the bill, sending it to the Senate for consideration. A win for President Biden and Speaker Kevin McCarthy.
Tonight, we all made history, because this is the biggest cut and savings this Congress has ever voted for.
The president called the agreement good news for the American people and says it protects key priorities and accomplishments from the past 2 years. Let's bring in Bloomberg's senior editor then, Bill Ferries, for the details. Bill, what is the timeline then for a vote in the Senate, and could there be any hiccups? How clear is that path?
Well, you're right. With the Senate passage looks a lot more likely after the vote we had in the House, where you had even 2/3 of Republicans joining in on this, along with an even higher percentage of House Democrats. It goes to the Senate. It could easily be on the president's desk by late Friday or Saturday. I do think there's a good chance of some hiccups or some politics being played. On the Senate, one person can really gum up the system a little bit. But there is, I think, broad recognition that this will be on the president's desk ahead of that June 5th, Monday deadline when the U.S. hits the debt ceiling.
So, Bill, how strong is Speaker McCarthy's position, given that he actually needed considerable Democratic help to get this passed?
Right, that's something a lot of very conservative Republicans are gonna be talking about in the days ahead. This did get broad Republican support, but he did need Democrats to get this over the line. But the reality is there are some of these Republicans are ones who have never in their political careers voted to raise the debt ceiling, regardless of who was in power. And there are some people who voted against it knowing it would pass, so they could take a politically safer option and vote against it, not worrying about whether breaching the debt ceiling was going to happen or whether a default was going to happen. I think he's relatively safe for now. The challenge the opposition to McCarthy has is that they have no viable candidate to replace him. Unless that changes, I think he's going to remain the speaker for the foreseeable future.
Thank you so much, Bill Ferry's there with the very latest on, of course, the avoidance of a debt default. Well, joining us now is Hugh Gimber, VP and EMEA Global Market Strategist at JP Morgan Asset Management. Hugh, as always, thank you so much for coming on. I feel like one day it's the worst news. The other day, joys ahead. Manufacturing in China is pretty strong. We avoided a U.S. default, and then the Fed may pause. Does that make sense to you?
So clearly, it's nice to start the day on a better note. It feels quite unusual to be here when there's some good news to talk about for once. But I think really what we're seeing here is in the case of the debt ceiling, yes, we have good news so far. I'd phrase this really as 2 down, 1 to go. We've passed the Rules Committee to get the deal onto the floor of the House. We've now passed the House. As you say, we still have to get past the Senate, but it's looking like there's good momentum there. I think the challenge here for investors is that there was really not very many parts of the market pricing any significant risk premium. So unlike the situations that we had in 2011 or 2013, where you'd already seen quite a lot of market disruption when you were heading into the X date, this time round, we've all been talking about it, but equities, bonds, credit haven't really been pricing in a major risk premium. And therefore, this, I think, is a time where instead of seeing a big market relief and a big market rally, investors are going to start to turn instead back to economic fundamentals, where we do still see things weakening.
And that keeps you, presumably, that keeps you defensive. Despite the uptick that we're seeing today and that trio of positive factors, you remain defensive. Just underscore why that is.
That's right. I mean, in really simple terms, I think there's one big question for everyone to be understanding in the remainder of this year. And that is, do you still need a recession to bring inflation down? Now, when I look at the market rally so far year to date, I think there's this idea that maybe we could get away with a scenario where inflation does tail off without a hit to growth. Certainly consistent with equity markets rising, with valuations expanding, and no meaningful deterioration in earnings forecasts. That, for me, just doesn't quite square up.
That's the Goldilocks forecast.
That's the Goldilocks forecast, and that's one that I disagree with, because I still believe when you look at the strength in the labor markets and that feeding through into core services, whether that's the US, the Eurozone, or the UK, we're still going to need a more meaningful hit to growth to rid the economy of this excess inflation, and that's what keeps us a little bit more cautious at this point.
I mean, you're right. It just doesn't make sense, right, that we can get away with this no landing scenario. But what kind of, could it be a mild recession, so not, a shallow, or would it be a protracted recession?
Yeah, it's a really important question, and we're still more in the mild to moderate camp. I don't think you're going to see earnings declines consistent with a typical recession of, say, minus 20%. I think you're looking more in the minus 5 to minus 10 kind of camp. And so that is going to keep people from getting overly bearish. I don't think this is a time to be running huge underweights to equities, but within an equity allocation, we think you want to be looking at every possible way, really, to build a bit more resilience into portfolios. And so that, for us, means, first of all, screening for quality above all else. And that's not only a growth view. That can be quality within value sectors as well. Some of the energy majors screening very well at the moment, given the resilient cash balances. And then also, I think, a return to some of the more old-fashioned styles of investing like income. Dividends, we think, are really well covered at this point. Payout ratios are low, and therefore, if we do see some deterioration in the earnings picture over the next 6 to 12 months, we think actually that dividends should hold up pretty well.
The wingman for Jay Powell, Philip Jeffries coming out and suggesting that there is going to be a pause in June, a skip in June. Of course, it leaves the door open for July, and that debate you'd assume remains within the FOMC. So it's not a done deal yet. But what is the market reaction to a pause in June and a reconsideration as the data comes in July? Is the market ready for that kind of move from the Fed?
Sure. So I think the June meeting is really all about leaving maximum optionality on the table for the Fed. They don't know where this data is going. Neither do we. We don't have great insight into what core inflation is going to be in 2 or 3 months' time, or where the labor market's going to be over that kind of time frame. So I think it would be right for them to pause in June. But I think, as you say, that comes with a message which is very clear to markets saying, well, hang on, if we don't see the deterioration in the data which is required to bring inflation down, then we have to leave all options on the table. And so I still think when you look at the balance of risks here, it's probably more likely that the Fed ends the year with rates above where we are today rather than below, because I don't think you're going to see the economy tail off quickly enough to justify significant cuts in the latter part of this year.
Okay, Hugh, staying with us, we'll get more of Hugh's calls. How to position within this environment, tech, China, and what to do with US Treasuries coming up. Just in the next couple of minutes, Hugh Kimber, of course, VP and EMEA Global Market Strategist at JP Morgan Asset Management. Coming up, as the ECB turns 25 years old today, we spoke to former President Jean-Claude Trichet. But how will the central bank face up then to the inflation challenge? And is that challenge becoming less acute? We discuss next. This is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right, I will concede. I can see you've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Or other authorities.
Could face bigger challenges.
Britain's next was going to keep rate World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make.
The ECB may be one of the world's most influential central banks, but it's also one of the youngest. Founded on June 1st, 1998, just 7 months before the euro, it had one simple mandate: keep inflation below 2%.
One of the biggest monetary experiments in history began with 11 nations. It would grow to a $14 trillion economy, covering a population of almost 350 million people.
In 2003, the first change to the mandate and its second president, Jean-Claude Trichet. When the financial crisis hit, the ECB threw the banks a lifeline. But as the economy limped on, the cracks emerged. When Mario Draghi arrived, the fate of the euro hung in the balance. By 2012, the difference in borrowing costs between Germany and Greece had blown out to almost 30 percentage points. This time, the euro needed a lifeline.
The ECB is ready to do whatever it takes to preserve the euro. And believe me, it will be enough.
And it was enough. After years of falling short of its 2% inflation goal, the ECB took rates negative in 2014 and then stepped up a monster bond buying program the next year. Christine Lagarde arrived just in time for a new kind of crisis. With the pandemic came more crisis measures, including a 1.85 trillion euro emergency program. In 25 years, the ECB has navigated its share of problems, but never an inflation crisis. Right now, the central bank is raising rates at the fastest pace in its history, and nothing's broken yet. But could some of the old stresses reemerge, or something new entirely? Oliver Crook, Bloomberg, ECB headquarters, Frankfurt.
Well, that was a look at the 25-year history of the ECB and, of course, some of the challenges faced by the world's youngest major central bank, including its recent fight against inflation. Now, in a few hours from now, we'll get Eurozone inflation data for May. That's after some of Europe's major economies saw the pace of inflation cool for the month. Now, former ECB President Jean-Claude Trichet also told us that ECB policy is heading in the right direction.
I was impressed by the fact that this target, this definition of price stability, has been reaffirmed very, very strongly by Jay Powell and by Christine Lagarde, so that the goal is clear and there is a joint, I would say, definition of price stability.
Still with us, Hugh Gimber, VP and EMEA Global Market Strategist at JP Morgan Asset Management. We were talking a little bit about how the market overall is just all over the place. It's technical terms, CFA level 5. But the ECB has kind of been, doing a good job. There are concerns about banks as, some of the TLTROs will change, especially Italian banks. We don't know what the energy complex is. What do you think is the biggest, hurdle for ECB right now?
No, I agree. I think the ECB has been on a very clear path this year, which is to say that they knew there was a major risk of big disruption in energy markets over the winter. Now that that has faded, they feel they have more work to do. And so I think that's a very clear message for markets. Yes, headline inflation is coming off. And again, as you mentioned, I think today we might get a slightly softer print on the headline given some of the weakness in the regional numbers earlier this week. But the problem for the ECB is really the core inflation number. And again, I come back to this point around the labor market. You're starting to see now significant wage growth in the Eurozone. That leaves the ECB more nervous about inflation expectations becoming embedded at a higher level. And therefore, I think there's at least a couple more hikes on the table, despite what might be a slightly softer number later on today.
Hugh, we've seen this rally for sovereign debt, particularly German bunds. Okay, reversing around the edges today, yields up about 2-3 basis points on the benchmark 10-year German bund. But in the context of the last 30 days, 30 basis points higher in terms of those yields. Do you chase that lower, I should say, in terms of yields? Do you chase that rally around German and European sovereign debt?
So I think there are two key principles for investing in government bonds at the moment. The first is that you want to focus on central banks that are closest to a pause and where core inflation has turned most definitively. So that makes me a lot more comfortable looking at US Treasuries than it does looking at German bunds or UK gilts. Same rules apply in emerging market debt as well. You think about some of the LATAM major central banks that are now edging closer to the potential for cuts even in the second half of this year. So focus on those where the pause is closest. The second one is I think investors have to get their head around the idea that owning government bonds today is more like holding an option. Right? It's not going to be about just a gradual glide path lower in yields. Rather, you're waiting and you're waiting and you're waiting for something to turn in the economy, but you're doing so knowing that there is now significant room for yields to fall and that negative stock-bond correlation would likely reassert in the event of a shock to economic growth. So I think this is a time to be patient, but also thinking, look, when you do get these periods where yields back up, that's probably a better time to be thinking about adding to duration.
But so Hugh, what do you do with equities? Because again, and we were talking about it, in the break before. If you look at luxury stocks, if you look at AI stocks, frankly, they're the biggest gainers, and then 2 days after, they get sold off.
Yeah, for me, the whole tech story this year is really a question about the earnings picture. One of my favorite charts at the moment is to compare the drawdown in tech earnings that we've seen versus the broad market over the past 3 recessions. So you go back to the tech bubble, you go back to the financial crisis, and then COVID. To me, at the moment, the market's using COVID as the wrong example to say tech earnings can just flatline during a period where earnings across other sectors fall. I don't see that repeating itself. I still think semiconductor revenues are going to be cyclical, and they will come under pressure if we see that economic weakness. I also don't think the version we had in 2001 is the right proxy, where tech gets absolutely crushed relative to the broad market. Balance sheets are stronger, but therefore you're left with something financial crisis-like where tech still has to come under pressure. And from these kind of valuations, it's harder for me to argue that the slowdown in growth that we see ahead is accurately reflected in prices today.
Does the lack of breadth concern you? What you strip out the top 5 or 6 tech names out of the S&P and you're flat year to date. But also, if you don't follow tech, you would have missed out on that 30% year to date rally.
So you can read this in both ways, right? You can make the case to say, well, this is the start of something sort of cracks in the index because of that narrowness. You can also say that for investors looking outside of tech, there's still plenty of value on offer, right? So you strip out the top 10 and you come back to an S&P multiple, which is more like 15, 16 times in comparison to about 26 times on those top 10 names. So yes, it's not a normal cycle where a bull market begins with very narrow market leadership. You need that to be broadening out to get more confident. But equally, for active management, this is bringing opportunities up because you're starting to say, right, well, it's not about investing at the index level or just focusing on those top 10. There are some attractive valuations to be had in places like energy. Some of the large cap banks at this stage as well, I think, are areas looking attractive, provided that you're screening on quality and that more defensive sort of balance sheet strength and low leverage that I keep coming back to.
Okay, screen on quality, you can find some value in banks, energy, and still the preference for US Treasuries over European sovereign debt. Hugh Gimber, always excellent, of course, VP and EMEA Global Market Strategist at JP Morgan Asset Management. Thank you. Let's get the Bloomberg Business Flash now. NVIDIA's CEO is said to be heading to China later this month to meet with tech executives in the world's biggest chip market. A source says companies on his itinerary include gaming leader Tencent and TikTok owner ByteDance. The CEO's first China trip in years will come as the US tries to curb Beijing's access to leading-edge chip technology. EV maker Lucid Group is raising about $3 billion in a common stock offering. The majority of the money is coming from Saudi Arabia's Public Investment Fund, which is buying $1.8 billion of the stock in a private placement. The US car maker has stumbled recently as it grapples with heavy costs, production challenges, and competition. That is your Bloomberg Business Flash.
Now, Tom, coming up, we'll look at your stocks on the move, including Dr. Martens, the iconic bootmaker, slumping after its full-year profit missed expectations. We'll have plenty more on that shortly, and this is Bloomberg.
Is as safe as it was when you were in the government? It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime. But we're going to have to be incredibly aggressive in making sure that crime does not increase. Are you involved any longer in New York City matters or your advisor? Yeah, the mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
Welcome back to the Open, everyone. 23 minutes into the European trading day. Look at that. We're seeing gains across the board, partly because of that manufacturing data from China. We will not see a default in the U.S., at least not this time. And then we also had a lot of chatter about the Fed pausing interest rate hikes. Now let's get stocks on the move with Joe Easton. Joe, bit of a tipple, 8:24 London time. You're talking Remy.
Exactly, perfect time to be talking about booze, isn't it? But so Remy, now this is a bit of a surprising one because the headlines were really negative. Remy today said that the US sales have dropped significantly amid economic uncertainty and also the fact that a lot of people stocked up on booze during the pandemic and still haven't got through that. They must have bought quite a lot of it. But the stock is up around 1.4% as we see on the screen. Now the full year earnings did actually beat expectations and the stock went into today at a 2-year low. So a lot of that is already priced in, probably because of some of the luxury goods outlooks that we've seen in the recent weeks that haven't been that good. People expected this to be weak. It has been weak and the stock is staying up around 1% at the moment.
Joe, you're also looking at DMs, Dr. Martens, the boot, the infamous boot out of Camden Town.
Exactly, so they're a classic boot maker, aren't they, Dr. Martens? And that stock getting hit really hard today, the worst performer in London, down 10%. Their full-year profit missed expectations, and analysts are saying there could be downgrades in terms of double-digit percent cuts to their earnings expectations. Now, Morgan Stanley writing in a note today that Doc Martens is past its peak brand momentum. So that's a pretty big call, given this is such a well-known brand, but they're kind of calling the end of their growth there. RBC, meanwhile, cutting their estimates by 15%. Analysts not liking this report at all. As I say, that is the worst performer in London for Dr. Martens.
Such like a 90s throwback. I'm thinking of like Crêpe Flambée with Remy and like Dr. Martens. FTSE 100 index changes.
So the FTSE 100, we had the quarterly rebalancing, the thing that we look out for every 3 months, and it brought some big changes. British Land drops out. That's been in the index for 22 years. And they're falling out, given that their property portfolio has been hit by these rising interest rates. That's weighed on all of their office buildings, particularly in the City of London, that houses some of the big banks in terms of UBS, TP ICAP, some of those tenants. Meanwhile, the one coming in is IMI. Now, this is an engineer that does robotics, automation, all the popular things at the moment, bit of 3D printing. That stock's done really well this year. Ocado, meanwhile, avoids the drop. This one was predicted to drop out just last week. FTSE said they expected Ocado to slide out of the index, but it has done an avoidance at the last minute. Ocado stays in. That one is higher today.
All right, Joe Easton, on some of these stocks to watch, some of these stocks on the move. Thank you. Coming up, we look ahead to Eurozone CPI data out later today and whether the end of the ECB tightening cycle is in sight. This is Bloomberg.
we're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience would get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Bloomberg.
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. The U.S. debt limit bill heads to the Senate after winning passage in the House amid a looming default deadline. Fed officials say the FOMC may keep the policy rate steady this month, but more hikes could follow. European stocks and U.S. futures are in the green. Plus, on the 25th anniversary of the ECB's founding, we get Eurozone's latest CPI readings amid signs that inflation is actually cooling. So, Tom, the markets seem to like the news today.
Yeah, it's that trifecta, as you said, of positive catalysts coming through for these equity markets. Europe snapping 3 days of losses, gaining across the benchmark 0.8% on that, slightly better than expected. That surprise in terms of the China data, we haven't been able to say that for a long time. And of course, the progress in Washington, and then hints that it looks like June is going to be a pause from the Fed. We're going to unpack that story for you just in the next couple of minutes. The DAX is gaining strongly, 149 points, adding 0.9%. Autos is a big factor there. Again, you can tie that to the China story. Energy also rallying. That's lifting the FTSE 100, gaining 36 points, adding 0.5%. We can look at the sectors now as we switch the boards and see how things are progressing this Thursday morning. Of course, the importance of the data out of the US as well, with non-farm payrolls coming out tomorrow. To what extent will that round out the picture around this tighter labour market? Media at the top in terms of your sectors, gaining 1.3%. There's basic resources. You've seen a really strong rally around copper and iron ore. Again, on the, at least for now, at least for today, the enthusiasm around demand out of China. Energy also rallying, Brent WTI up after pressure on the commodity space, on the oil space, gaining 1%. Just three sectors in the red. Real estate at the bottom of the list, down 0.5%. Of course, the ECB has flagged this as a potential vulnerability in terms of financial stress. Fran.
Now, Fed Governor and Vice Chair nominee Philip Jefferson has signaled that the central bank is actually leaning towards keeping rates steady in June. But the central bank's position may be tested after U.S. job openings came in at their highest in 3 months. Well, joining us now for more is our very own Valerie Teitel. So, Valerie, first of all, there is a thinking inside the Fed, and we actually heard from two Fed governors, that if you pause in June, it doesn't mean you're done. It just gives you a bit of time to pause and reflect.
Yeah, so even though we've heard, ad nauseum from Fed members that a pause in June is likely, they continue to communicate that they're on a hiking bias, meaning that they're probably not going to be pausing for long, and any strength, any upside surprises in the data is going to keep them hiking, most likely in July. But at the same time, we've been having that communication that the data coming out of the U.S. economy continues to surprise. The job openings data came in strong yesterday, and that adds to Friday's beat beat in core PCE and in durable goods, which is important because durable goods is a feeder into GDP. It's showing up that the U.S. economy is holding up still very well under the weight of 500 basis points of Fed increases in the last 14 months. But what I do think this means is that if the Fed is more likely to communicate this pause in June, we're probably more likely to hear some sort of hawkish language out of Powell in the press conference. And don't forget, we get their summary of economic projections at this meeting, which is that infamous dot plot. The more likelihood that even though they pause, maybe we see one of those dots go above 6, or maybe we see those dots shift higher. Remember, those dots are very key for the market because it gives us a glimpse of where these Fed members are seeing the terminal rate this year.
Yeah, and obviously, and we see that often, don't we, Powell referencing the dot plot when he's quizzed on the trajectory around rates. To what extent do the non-farm payrolls, though, and the importance of them this week, is that undercut by the signalling from Jeffries that you're going to get a pause? And as you suggest, it could be this hawkish pause.
You know, it's going to be a tough call because, look, if we get a hot payroll print on Friday and that includes the headline number and maybe wage gains being strong as well, that does bode well for the Fed not pausing. But the issue is that their blackout period begins on Saturday. And that really leaves them, what, a few hours to communicate a shift in direction. It's probably unlikely we'd get that, but again, any big beat in this data is more likely that those dots in that dot plot will shift higher, that Powell will be forced to sound quite hawkish in his press conference in order to appease more of the hawkish members of the FOMC.
Yields up on the front end at the 2-year, gaining 5 basis points in the session, 445 on the 2-year. Valerie Teitel, thank you very much indeed. Looking ahead, of course, to the non-farm payroll print tomorrow, forecasts of around 195,000 being added for the month of May. From inflation and the labour market in the US then to Eurozone inflation data, we're going to get that for the month of May as well shortly. That's after some of Europe's major economies saw the pace of inflation cool in data over the last couple of days.
Now let's get more from our Bloomberg Europe correspondent, Maria Tadeo. Maria, good morning. When you run us through some of the data, of course, CPI in focus today, we've had a number of countries where we saw inflation really ease off a bit.
Yes, Francine, and good morning to you too. When you look at the numbers and the data that we had yesterday, and essentially you're looking at the big four, particularly Germany, of course, a lot of focus on that number yesterday, which again seemed to cool. You had French inflation also cooling. Then you had the number from Spain significantly cooling. Italian inflation also eased, not as much as expected. And of course, these are different economies with different dynamics. But what matters here is the trend, which again should point to this cooling down, which could be reflected in the number that we're about to get in a few hours' time from now. When you look at the survey that we have on the terminal, we see inflation at 6.3%. Obviously, this is way above the European Central Bank target. There's no question about that. But the idea here is the trend. The focus, however, for the ECB will also be on core inflation that is also expected to ease, but not as fast. And that's the dynamics that we're seeing. Headline inflation immediately dropping as soon as energy prices do, but headline inflation also stickier, perhaps. It's that combination, that balance between the two of them, the European policymakers will have to really weigh on in this decision that is coming up.
Yeah, and we were hearing, and we're speaking to JP Morgan's Hugh Gimber just earlier in the show. He still expects a further 2 additional hikes, another 50 basis points coming through from the ECB. Look, Marie, you know very well the debate that's going on within the Governing Council. What is your sense as to how that data plays into that debate around the doves and the hawks?
Look, I think it will come to data because the European Central Bank has said it. They're now mega data dependent. They always have been, but now really look at the transmission, but also details of it, like core inflation. I mean, this has been a recurring theme. We also know there will be new projections that will come up with the meeting that is happening in 2 weeks. What is clear now is that the European Central Bank has signaled they are not done yet. So this hike in June is very well priced in by the market. It is very well expected, but we know that they've also probably entered the final stage. And it's at that point where you see tensions already happen. And we've seen that repeatedly in the meetings previously, this idea that decisions were not fully unanimous, that there is a debate on the board between what happens after the summer too. So a lot of this will feature into it. What is interesting though is that when we saw the numbers yesterday, especially the German CPI print, the market reversed this idea that 2 hikes are definitely on the cards, and that a cumulative 50 basis points actually dropped below that. So yes to June. What happens after, that's going to be a real debate.
Thank you so much, Maria Tadeo, their Europe correspondent, of course, for Bloomberg. Coming up, JP Morgan leads Wall Street's AI race. Who else is in the running? What are the risks? We'll discuss that next. And this is Bloomberg.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new Bankrate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Welcome back to the Open. We are 40 minutes into the European trading day. You're seeing some optimism across these equity markets, snapping 3 days of losses in Europe, getting 0.8%, so it's becoming a little bit more convincing now on the catalyst coming through from slightly better than expected China data. The Fed pause seems to be being baked in a little bit more, and of course, the progress of that debt deal in the US. Across your sectors, 2 sectors in the red, but leading is media and energy, getting 1.4%. Let's get to what's happening in AI then. The AI revolution is unfolding on Wall Street, with JP Morgan taking the lead. The lender advertised over 3,600 AI-related roles just in the 3 months to April. That's forcing its rivals to play catch-up in a race that many are urging caution over, including Warren Buffett. Will Shaw, our finance reporter, joins us now with some of the details. Will, which Wall Street banks then are making the most progress in building out their AI capabilities?
So like you say, JP Morgan is forging ahead particularly fast at the moment. So the amount of jobs it advertised for was more than double or about double that of its nearest competitors, who were Citigroup and Deutsche Bank. Now, the most enthusiastic banks about in AI, we're told by the consultancy Evident, about 40% of the roles that they're advertising at the moment are in some way related to AI. That might include, for example, quants, software engineers, or people working in governance and ethics around AI. So there really is something of an arms race going on at the moment that's been triggered by the unveiling of ChatGPT.
So, Will, how are banks actually using AI?
They're putting it to a number of different uses. So, for example, Deutsche Bank are using it to pair up their clients with particular securities like equities and bonds. Morgan Stanley have applied for a patent which would enable them to use AI to analyze communications from the Fed and try and get a sense of what interest rates are going to do next in the US. BNP Paribas, for example, are using it to detect fraud and money laundering.
Okay, that's all it sounds all very positive, but we can think back to the flash trading as banks embraced this kind of technology, at least built on their technology capabilities. So there's got to be risks. We know there are risks around AI. What are people saying about the concerns about how you fold artificial intelligence and large language models into the banking sector?
So Warren Buffett has flagged concerns on an earnings call recently about how once you've invented AI, you can't really take it back. That's like broadly the abstract concern. To be like more specific, one of the issues that people raise is you don't really know what goes into a large language model like ChatGPT at the beginning. All you see is the analysis that it puts out at the end. So there's very little accountability and transparency into like how it's coming to the conclusions that it is. It's having to, sometimes some of these models are having to hoover up low-grade data from all over the internet in order to train themselves to the level that they need, which means like sucking up analysis of Reddit and chat like formats like that on the internet, leading to like low. You know, we all know
a lot of
there's
rubbish,
a lot of rubbish.
So, I mean, I guess it will change, right, as also the chip processors become more sophisticated. How will it change? Is it too soon to know how it changes the banking industry?
So, a month or two ago, analysts at Goldman Sachs put out a report warning that 300 million jobs ultimately could be exposed to automation in the future. They're not just talking about banking jobs, that's like across industries. Obviously, that's a very high number, and people will be worried about that. But there are these issues with accuracy around large language models that a lot of people say that will mean humans always have to have an oversight role here.
Thank you so much, Will Shaw, they're a finance reporter. One of the funniest memes is someone saying, like, AI, you know, if you're a graphic designer, relies on the human giving you precise information on how you want the graphic, so there's no chance they ever got it.
Well, let's hope that. Some will be hoping that stays the case, won't they, in terms of preservation of jobs.
Now, the aftermath of UBS Credit Suisse mega deal is posing fresh challenges for the Swiss bank and its presumed chief executive officer in waiting. When Iqbal Khan joined UBS from its rival in 2019, the move sparked a tabloid scandal over a cloak and dagger surveillance operation on the star banker. But in this year's forced marriage of Switzerland's two biggest lenders, he's been conspicuously low-key. Let's bring in Bloomberg's Tom Metcalf. Tom, always great to speak to you because you always bring us like the juicy stories, and this is a pretty big, juicy story. So how would you describe Iqbal Khan's current position?
Yeah, it's interesting. He's kind of in a bank. He's been doing well there. As many insiders say, he's likely to be one of the sort of the heir apparents at UBS. But this acquisition of his old firm, of course, has actually kind of changed the stands a bit, right? So, as you'd expect, the bank around him's changed, and that's kind of made his position a little bit less sort of kind of clear-cut in terms of being this sole sort of front runner. And now that, you know, they've brought in obviously some Credit Suisse talent, and there's lots of other people within UBS who've been given pretty plum roles in terms of how to integrate Credit Suisse. So, you know, the big question is Khan, you know, as far ahead as other people, you know, are as far ahead as he was once?
I mean, we all remember the spying scandal, the surveillance scandal, of course, when he left Credit Suisse. How much goodwill does he have left, or does he have with those current Credit Suisse employees?
Yeah, so look, we understand that, you know, there's definitely some tension, you know, with some people. So he's been flying out to various regions and, you know, looking to sort of, you know, pitch the UBS way and you know, trying to smooth things over. I think, you know, within UBS, he's seen as doing a very good job. He's obviously running the whole wealth unit, which is an absolutely massive gig. And, you know, again, that seemed to be doing quite well. Some of the stuff he's imported from Credit Suisse has been bringing in extra revenue, etc.
Tom, what are you looking after, or what are you looking for actually in the next chapter of the UBS Credit Suisse deal?
Well, it's interesting. Yesterday was meant to be the day that the deal closed between UBS and Credit Suisse. You know, our understanding is that's been shunted back by a few weeks just to sort of dot the I's, cross the T's. So that's the next big thing in this whole saga, is that legal close. And then, of course, you know, into the summer, you have UBS's set of results, which will be absolutely fascinating. You know, how they present this, you know, what it starts to do to their results, or, you know, what they say it's going to start to do to their results.
Tom, as always, thanks so much, Tom Metcalf there, who oversees all of our coverage, of course, for finance here in London. Now, coming up, we'll have plenty more, of course, on the markets. We focus on Chinese data. We look ahead to some of the jobs reports we'll get, of course, and whether it's as relevant as it used to be because of what we heard from the Fed yesterday. This is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. Yeah. There's nothing closer than the phone in your hand.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Welcome back to the Open, everyone. 50 minutes into the European trading day. For the moment, we're still seeing gains across the board. One of the biggest gainers is, of course, the DAX index, 0.9% higher. Look, there are concerns about AI and some of the AI stocks or technology stocks that filtering through to Europe. But overall, the focus is on better than expected economic data out of China, the fact that the House passed also the debt ceiling bill, and then a lot of focus, of course, on jobs and what that means for the Fed going forward. We're also getting some PMI out of Italy. I think, let me see if it's coming out, but we have to put this PMI in conjunction with what we're seeing, of course, on the CPI front. So we're also getting quite a lot of big news a little bit later on. So I'm not seeing that Italian PMI yet.
So the manufacturing data for Italy...
As soon as it's out. Is it out?
Yeah, for May, for the month of May, PMI falling to 45.9. So that's just slightly above the forecast, 45.9 versus the forecast of 45.8. But again, it's a reminder, it's in contractionary territory, of course. And when it comes to France, May manufacturing data coming in below the estimates, 45.7. So again, it just underscores that there is this divergence between manufacturing and the services part of the European economy. Let's get to an important interview that we set up yesterday. The incoming CEO of advisory firm Lazard says the US will eventually be hurt by its financial problems, and lifting the debt ceiling and the debt limit will not resolve underlying chronic issues. Peter Orszag told us more about where he sees the headwinds.
Normally, when M&A falls as much as it has over the past 2 years, you see a boom in restructuring. That hasn't yet happened. And the reason I think is twofold. One is we don't have a recession, which is what normally happens when M&A comes down this much. And secondly is the expansion of cov-lite lending over the past 5 or 6 years. More than 80% of the lending over the past 6 years has been cov-lite, which means you're not triggering the covenants as early in the process. Doesn't mean it won't happen, it just means that it's delayed. And then for Lazard, one of the things that's fantastic is we've historically been very focused on the debtor side. Our restructuring practice, which by the way is ranked #1 in the world right now, is expanding into the creditor side so that we can do both sides of the activity on both sides of that business.
Hey, Peter, it's Alex. It's so good to see you. Congratulations on the gig.
Thank you.
I hear you on like, this is how we're setting up. There's going to be a downturn, but the cov-lite kind of pushes it out. Do you guys have an idea of when stuff will turn?
I don't think anyone has a great sense of that. What I'd say if you're asking about the M&A market is there are some key underlying drivers that are very positive for the market, and then there's some headwinds, one of which is being taken off the table as we speak. So the key underlying drivers are things like technology, the energy transition, the life sciences revolution, and so on. Those are all very positive for M&A activity. On the downside, or the headwinds, are market volatility and the interest rate trajectory, along with the debt limit, which maybe we'll turn to in a minute because it's being taken off the table, and then the regulatory environment. The good news is the underlying drivers are durable. Most of the headwinds are ephemeral. And so I think if you look out over the medium to long term, the prospects for a significant amount of ongoing M&A activity over the long term are very, very positive.
Peter, that's the long-term view. In terms of time frame, I just want to push you a little bit. Tom here in London, and thank you for joining us. In terms of by the end of this year, there's a debate, obviously, in terms of when the deal-making comes back, when that M&A comes back. Do you see that activity picking back up for you in the business by the end of this year?
Well, we'll have more to say about that when we report our second quarter earnings. So I'm going to just hold off on answering that question. What I would say is we are very well prepared and we are very well positioned for whatever market conditions come our way.
Speaking of market conditions, like you'd look at just the news yesterday, Goldman cutting a couple hundred more jobs. Morgan Stanley has been on its second round of job cuts, really. Lazard made a decisive decision here to cut 10% of its workforce. How does this affect jobs across the financial industry? And honestly, Peter, you were the banker, frankly, to First Republic as it was figuring out its fate. Is there more pain to be had across the financial industry as we look through the year?
Well, look, I think there's a lot of stress on the regional banking system in particular. And then also, as we've discussed before, M&A volumes are down 60% over the past 2 years, especially because many firms, including Lazard, did less headcount adjustments throughout COVID for understandable reasons. That's exactly what one would hope companies would do, which it would be a bit more protective in the middle of a pandemic. The combination of that and a substantial decline in M&A volume in the market as a whole is leading to the kinds of headlines that you were just referencing.
The incoming CEO of Lazard there, Peter Orszag, on the debt ceiling, on the overall debt load for the US, and of course on the prospects around a pickup in activity when it comes to M&A and that part of the business. In terms of the data coming through from Europe, we have some more lines crossing, this time from Germany. May manufacturing PMI coming in at 43.2. Slightly above the estimates at 42.9, but again, firmly in contractionary territory. It's a bit of a mixed picture in terms of this manufacturing PMI across Germany and France. But what it does show is that manufacturing remains clearly under pressure. Across the European equity markets, as we look at the euro dollar at 106, and it's a leg lower now, down 0.2% for the single currency. You're still seeing some optimism across these equity markets, gaining 0.7%.
That's it for the European Market Open. Surveillance Early Edition is up next, and this is Bloomberg.
on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power.
This is Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg. This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. The U.S. debt limit bill heads to the Senate after winning passage in the House amid a looming default deadline. Fed officials say the FOMC may keep the policy rate steady this month, but more hikes could follow. U.S. equity futures are little changed, even as Europe opens higher. Plus, on the 25th anniversary of the ECB's founding, we get the Eurozone's latest CPI readings amid signs that inflation is actually cooling. Now, first thing is first, let's check on the markets. We also have a bit of PMI figures overall for the euro area. So we had the individual countries just 10 minutes ago. Euro area May manufacturing PMI coming in 44.8. Anything below 50, which this obviously is, means a contraction. It is a little bit better, really just a touch better than that preliminary figure of 44.6. Now, in the markets, let's check on euro dollar. I don't think it's having a huge amount of change, but 106.70 is what we're doing right now. The focus is on three things today, and actually they all seem to be pushing towards more positivity in the market. Again, it changes quite quickly. Every couple of days, the markets seem to be flip-flopping. They're all over the place. They're positive about China, then they worry about China. Today, we did have some manufacturing data out of China that was beating expectations, and so we have the China recovery play maybe back at the margins, the U.S. default now being taken off the table because we have a resolution certainly with the passing of the House, and then of course the third encouraging news for the markets that the Fed could pause in June after we heard from two Fed governors. European stocks gaining 0.7%. You can see it's not having the same effect in futures. The focus is also on AI and the fact that after the huge rally that we saw on the back of NVIDIA, we're now seeing a little bit more pressure. The two-year yield at 4.45, and then crude oil 72.79. Now, I don't think there is much difference, but it's interesting to see there's not much difference in how some of these countries behave differently. But what was interesting is actually the DAX seems to be powering ahead, the biggest gain in terms of indices, 0.9% higher. So the debt limit deal has cleared the House, a major step towards avoiding a historic U.S. default. Lawmakers from both parties joined to approve the bill, sending it to the Senate for consideration, a win for President Biden and Speaker Kevin McCarthy.
Tonight, we all made history because this is the biggest cut in savings this Congress has ever voted for.
Well, the president called the agreement good news for the American people and says it protects key priorities and accomplishments for the past 2 years. Now let's bring in Bloomberg's Ross Matheson with the very latest. So Ross, what's the timeline for a vote in the Senate, and could there be any last-minute hang-ups at this point?
Well, the good news for President Joe Biden is that Senate approval is virtually a given, which means this deal does get through, and that takes the debt ceiling off the table through the US election cycle, and it only caps spending for 2 years. The main question is simply, when may a Senate vote happen? We have Republican leader in the Senate, Mitch McConnell, indicating that vote could come as soon as today. But beyond the passage, there are some other issues. Basically, some of the hard choices on spending have been left for after this deal gets through. And that means you're going to have some wrangling that goes on, particularly up until October, about some of the nuts and bolts about what gets cut and what doesn't. A lot to be ironed out. And of course, there are groups that are very unhappy with this deal. You've got progressive Democrats who say spending cuts are going to hurt a number of people in America, particularly the poor. You have ultra-conservative Republicans saying, hang on, spending's not going to be trimmed or cut enough or managed enough. So really, you've got quite fraught negotiations to come well after this deal gets through, possibly as soon as today. And that's really where we're going to see the fighting come out and the mess come out, which is exactly what gets trimmed and from where. And there's a lot still that's not clear on any of that.
So, Ross, how strong is Speaker McCarthy's position, given that he also needed considerable Democratic help to get this passed?
Well, his position has always been questioned, really, in some way. Of course, it took him, a dozen goes to become Speaker in the first place. And to do so, he had to make an agreement that a motion to vacate the chair, which is really an immediate vote to remove him, could come from one single person in the House bringing it. So that's put him in a delicate position from the outset in a House with only a narrow majority for the Republicans. And now you do have one representative, Dan Bishop, saying he will call for a vote to remove the Speaker. And as I was saying, like, ultra-conservatives say that McCarthy made a bad deal. It only got through Congress, really, with the support of the Democrats, and less so the Republicans. And there is a precedence here, of course. His predecessor, John Boehner, he fell afoul of this in 2015 when Barack Obama was in power by doing deals then. But at the same time, McCarthy's been very visible through this process. He's not shied away from the media. He's remained front and center. And he may get some points just for doing that. And also for the Republicans, it could be self-inflicting damage to have a speaker fight at this point in time. It will create a mess for themselves they don't want. So perhaps that also might work in his favor.
Ross, thank you so much. Ross Matheson there with the very latest, of course, on this U.S. default. Now, we'll get Eurozone inflation data for May in the next hour. That's after some of Europe's major economies saw the pace of inflation cool for the month. The former ECB president, Jean-Claude Trichet, told us ECB policy is heading in the right direction.
I was impressed by the fact that this target, this definition of price stability, has been reaffirmed very, very strongly by Jay Powell and by Christine Lagarde, so that the goal is clear and there is a joint, I would say, definition of price stability.
Well, let's hear from our Europe correspondent, Maria Tadeo. Maria, run us through the data. So Euro area CPI in focus today.
Yes, Francine, very much in focus. We are waiting for that piece of data for May to hit in about an hour's time from that. We already had a number of national prints which would indicate a cool down for May. When you look at the details on the survey that we have on the Bloomberg, yes, another decline in headline inflation, a minor decline in core inflation expected, but not as fast. And that takes us to really what is the intellectual debate going on at the European Central Bank at this time. What is a persistent decline in inflation? When do you say, okay, the forces of monetary policy have really kicked in and inflation is on its way down sustainably? So you have to separate perhaps the energy to those forces that are more persistent in time. And Francine, just briefly, yesterday we spoke with the Vice President of the European Central Bank, Luis de Guindos. This morning he is on Spanish radio repeating this message that the ECB has probably entered the final stretch of the hiking cycle, and also says the 25 basis points, that is probably the new normal now. So that takes us to that decision in 2 weeks' time. Again, a clear indication it will be another hike, possibly around 25 basis points. The debate is now what happens next.
Maria, thank you so much, as ever, for that insight. Europe correspondent Maria Tadeo joining us this morning. Coming up, we speak to renowned economist and author Dambisa Moyo about the global economic outlook. That's next, and this is Bloomberg.
Okay, so you're moving in on me. Quick. Distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right, I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
The names that move markets are on Bloomberg.
The regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics. What I see is a banking system that overall is well capitalized, still has very solid earnings, but you know, we're monitoring the situation very carefully.
Nobody covers business like Bloomberg, your global business authority. The top names at the Fed are on Bloomberg.
Right now, if you had to tip the scales, the next move is going to be an increase or a cut. It's pretty heavily weighted to the increase for me.
Nobody covers the Fed like Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, our next guest is a renowned economist and author, a Harvard and Oxford graduate. She sits on the boards of 3M and Chevron. She's penned 4 New York Times bestsellers on everything from why democracies fail to deliver growth to China's race for resources. Dambisa Moyo, frankly, just a very big brain. Welcome to Bloomberg. You're also Baroness and House of Lords, so you kind of really put everything together to look at the biggest challenges facing our economies. And I can't figure out quite yet if it's just inflation in the short term and then AI is the biggest unknown for the next decade.
Yeah, so glad to be here. I think the most important thing is growth. That is the question that everybody's asking about in public policy rooms. You know, if you think about the business sphere, everybody's talking about growth. And obviously anything that potentially could increase growth is something that is of great interest. And so AI obviously is a big piece of that discussion, notwithstanding enormous headwinds that could also come from that.
So how do you see it? Is it a transformational technology that will leave many companies behind if they embrace it, or is it a job destroyer?
Look, so I think just deferring to people who really are in the know, the cold face of this. I mean, I was just in a room listening to some of the things that Sam Altman has said. I mean, obviously, the deep mind people have talked about this. There clearly is going to be job diminution. And I think it's important for us, from a business perspective as well as from public policy, to accept that reality, meaning thinking about whether there's a new paradigm for what the role of government might be. You know, I'm not a big government person, but we have to think about the possibility of UBIs, or universal basic income, thinking about a welfare state, but also the transition from a business perspective. What kind of businesses can generate returns above the cost of capital in an environment where there might be less demand for labor?
So what do you think is some of the most interesting when you look at board levels? And I know you wrote beautiful books, you know, saying how boards work. Yes. Like, what are they asking themselves right now? Is it how they can support government the other way around, or do they feel like they just need to go at it alone?
Well, I think that there's no way we can survive. I mean, the reason companies exist is at the will of government, because of regulation, because of the tax environment. And so they're obviously, the more we can work together, the better. But at the same time, businesses have to really take a cold towel to their heads and think about business models. How do we think about capital allocation? How do we think about labor? But also, most importantly, productivity. Those 3 things are the key engines for economic growth in a world where there might be less demand for capital because for 1 unit of capital, you can generate more returns in terms of gains in productivity. In an AI world, we might need less capital, we might need less labor. And so how do we think about those trade-offs?
I mean, how do you see, I mean, I have to say productivity has been you know, the big unknown, the big question mark for a lot of G7
big disappointment,
countries,
actually.
especially here in the UK.
Yeah.
Like, is there anything in the medium term that we can do to get this up would generate growth?
So I think that there's a lot of debate about whether or not we need to and how we should be bringing back labor into the markets, thinking about reskilling. I mean, all of these are ways that people are thinking about deploying talent. So it's the sort of, it's not man versus machine, it's man and machine kind of statements that you've heard before. I think that there's a bigger question to be asked about how do we think about business models in a world of AI. What I mean by that is that, you know, the traditional idea of 1 unit of capital, 1 unit of labor could generate with productivity huge gains might actually be facing a diminution. And I think that's the question that we're looking at right now.
And it's difficult because you keep on hearing it from really AI experts that it's the first time that we have such a big piece of technology that doesn't really put the human right at the center of it. It's actually really the technology that could change everything.
Exactly. This is the laborless growth point.
But so what does it mean for, you know, are we going to create quality jobs? And again, if you're on a board, if you're, you know, as an economist, like, how do you find out what needs to happen so that we still have a workforce participation?
Yeah, I think this is the big question. At a micro level, do we need more labor? But I think at a macro level, this could break up the whole idea of convergence that we've seen from emerging markets to developed economies. So if you think about the last 60 or 70 years, how did we get a lot of growth uptick? We brought women into the workforce in the 1950s. We had China sign up to the World Trade Organization in 2001 that brought more people into the workforce. But now we're talking about really a breakdown in that workforce and thinking about having fewer workers to generate more productivity. So I think this is a fundamental point. Keynes talked about this in the 1930s. He forecasted by 2030 we'd have a 15-hour work week. We've seen the arc of shifts in the economy from agriculture to manufacturing to services, you know, really break down. So as you know, 1900 we had about 60 to 70% of the workforce in agriculture. Now it's less than 2%. But in each of these changes, the workforce was absorbed into new skills, into new responsibilities. And now the question is, will that happen again? I'm not of the view that we'll have no new jobs, but I think the type of jobs that are going to be will survive, I think, are going to be highly technical, and this could be a problem for both emerging markets, but also for companies that don't catch up.
And I was going to say, actually, does it change the composition of, you know, continents? So how certain countries will do better than others, or really industries that will be completely disrupted, in certain cases, disrupted again?
So I'm going to be a good economist here and say on the one hand and on the other hand. On the one hand, I worry because I do think the precise skills that are necessary to succeed in an AI world are going to be skills that many emerging market countries just don't have. I mean, I'm talking about poorer emerging market countries. Obviously, China is a leading competitor in AI and quantum computing, etc. But on the other hand, there's a point that actually the world is becoming even more flat. And so productivity gains and things like open sourcing mean that anybody, anywhere can tap into those productivity gains. And therefore, there could be enhancements on a broad-based level. But I think these are questions that are still open out there. You and I haven't even talked about what are the risks and some of the headwinds that could come from AI that could undermine this whole productivity gain story. And also, maybe we don't see as rapid a diminution in jobs as sometimes we worry about.
I feel like today, this is a perfect, like, Baroness Moyo day, because we have quite a lot of China data that came in better than expected. 3 days ago, it was worse than expected. We have, you know, the U.S. default that's kind of been parked for the moment, and then we have a lot of Fed talk and the fact that the Fed could pause in June. Are central banks overall doing a good job in managing this, you know, inflation, which is frankly all over the place?
Look, I'm much more sympathetic than I know the narrative's been quite critical. I actually was in Jackson Hole last August. I'm going again this year for the Fed meeting. I think it's a hard needle to thread, and you know, we can sit here and speculate about whether they should have known and whether they should have acted more quickly. But given where we are today, I think that the story is still quite murky. I mean, you've seen the Spanish numbers. We've got a relatively deflationary environment in China. And on the other hand, we still have, core inflation and actually inflation rising in many economies. And so I think, it would be very easy for me to be in the peanut gallery and throw stones. But I think on the whole, I think we're not in a bad place.
But is there, and there is a narrative that actually now we'll get away with not crushing the economy. Is it wishful thinking? I feel like there's...
Too early to tell. I mean, if I think about some of the data that I see in inventories, some of the slowdown I've seen in automotive sector, for example, I think there's reason to be worried. I think also there's a paper that came out of the BIS talking about how when you have these rapid rate hikes, the sort of accidents or challenges in the economy come later. So, I mean, I'm much more of that view. I think we've seen rate hikes. I think we could continue to see some challenges in the economy.
You sit in the House of Lords. What's the prescription for the UK to move forward right now in terms of growth?
So I've been very clear. I don't think a combination of high taxes and high regulation is a formula for success. I've been very clear in that. I was in my maiden speech around the spring budget in March of this year. I do think that, like most things, we're trying to solve today's problem today, but we should continue to think about the longer term prospects for growth and really the numbers that the Chancellor forecasted through the March budget, I think are quite worrying. We're talking about 2%, 1%, 2%, not just in the UK, but in the developed economies in general. And I think those are things we should be worried about. The OBR has also forecasted weak growth.
Dambisa, thank you so much. As always, I mean, we could talk for another hour, so you'll have to come back.
I will be back, Francine. Thank you.
Dambisa Moyo there, joining us on a wide range of topics. Now, coming up, the BRICS bloc of nations could be discussing plans for a future where global trade no longer depends on the dollar standard. They're meeting in Johannesburg today, so we'll have plenty more on that shortly. And this is Bloomberg.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
So I think the main thing we did, which was not so easy, was to stick with our process. And then it kicked in big time in the last really 2 years.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars. only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Well, let's get straight to the Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Shares in ADNOC Logistics and Services have soared on their debut in Abu Dhabi. The move follows a hugely oversubscribed IPO for the maritime logistics unit of Abu Dhabi's main energy company. The share price jump was the third biggest globally this year for a listing, raising more than $500 million. Now, U.S. job vacancies unexpectedly surged in April to the highest level in 3 months. Official data showed the number of available positions climbed to 10.1 million from an upward revise of 9.75 million in March. The reading exceeded all estimates in a Bloomberg survey of economists, giving the Fed more reason to consider hiking rates again. NVIDIA's CEO said to be heading to China later this month to meet with tech executives in the world's biggest chip market. A source says companies on his itinerary include gaming leader Tencent and TikTok owner ByteDance. The CEO's first China trip in years will come as the U.S. tries to curb Beijing's access to leading-edge chip technology. And that's your Bloomberg Business Flash. I'm Leanne Gerrans. Francine.
Leanne, thank you so much. Now, foreign ministers from the BRICS bloc of nations kick off 2 days of meetings today in South Africa. The group, which represents 40% of the world's population, is set to debate the possibility of a common currency. Now, member states are also expected to discuss the subject of new entrants. Now, for more, we're joined by Bloomberg's Sembile Tsele out of Cape Town. Sembile, what is expected to come out of this gathering, and could that actually include talk of a common currency?
Morning, Francine. Thank you so much for joining us. We are live in Cape Town, where the BRICS ministers, that is Brazil, Russia, India, China, and South Africa, of course, will be meeting ahead of the August summit that's set to take place a little bit later this year. Today, the 5 foreign ministers will be meeting to set an agenda, as it were, for that meeting when it does come. And of course, some of the big ticket issues that will be on the table is the expansion of BRICS. It's this country of clubs. They're looking to maintain more global influence in the world. And another point of discussion that has also come up is the idea of a common currency, of course, to try and reduce sort of the dominance of dollar, as it were. And so what they'll be discussing today is the modalities around expansion. You have 5 countries in at the moment. There's a queue of others, the likes of Iran, Saudi Arabia, United Arab Emirates. They are amongst those that have asked to be considered to join what they, I assume, think there will be a formidable bloc in the coming years in terms of economic and military might as well. So those are some of the things that will be on the table over the next 2 days. Tomorrow, the Friends of BRICS will be joining them. Tomorrow, the Friends of BRICS will be joining them. And then, of course, in the background, struggling to hear you.
All right, Sembile, thank you so much. I think we're having a little bit of interruption on our Wi-Fi. Sembile Tsele out of Cape Town. We'll have plenty more. Up next, the UK show. This.
Do you think New York is as safe as it was when you were in the government?
It's not as safe as it was. Crime is clearly rising. I mean, it's not back to the dark old days of, pre-Giuliani in the early 90s. But we got to be careful because safety is the foundation of everything. And so I know the current mayor is committed to reducing crime, but we're going to have to be incredibly aggressive in making sure that crime does not increase.
Are you involved any longer in New York City matters, or you're advising?
Yeah, the mayor and governor actually asked me to co-chair a panel or a task force on reviving the commercial districts throughout the city. So I've been in the middle of that.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
crowning Britain's next.
Was going to keep Rain World Cup. This is a 3.
As the economic picture does.
The OK is getting ready to make a decision.
Young adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new bank rate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
Good morning, everyone, and welcome to Bloomberg UK. I'm Francine Lacqua here in London. Now, this morning, we're exploring the future of the UK auto industry under threat from trade rules, higher costs, and fierce international competition. As the sector switches to electric, Britain risks falling behind in the race to build EVs. Now, one of the big stumbling blocks is a requirement under the Brexit deal, which could add tariffs at 10% on cars traded between the UK and the EU. Now, the British government has until the end of the year to negotiate a way around a commitment requiring 45% of components in electric cars to be sourced in either the UK or the EU. That's for manufacturers to retain tariff-free access to the EU market. Now, car makers say the deal threatens the industry, with Stellantis warning that British car plants will close. This is what the Bentley chief executive told Bloomberg.
The good news is we got a free trade agreement with Europe post-Brexit, which involved the automotive industry. So we get mostly the same ability to trade with Europe as we did before, but it's way more complicated and it does cost us more money. Millions per year, not tens of millions per year. But there's always devil in the detail, and one of the details is that starting from next year, and even worse in 2027, there is a rules of origin clause which says a certain percentage of components going into the vehicle has to be sourced in Europe to avoid future tariffs. And at the moment, the amount of supply base in the UK, and particularly batteries, means it's unlikely to be able to hit that threshold. So volume cars going into Europe would have to pay the duty and the taxes, which makes them uncompetitive.
Well, the UK government has told Bloomberg it's working with the EU on car factory rules. Here's the Business and Trade Secretary speaking to us at the Qatar Economic Forum.
The EU, you're right, is our largest trading partner. We have a free trade agreement with them. But the terms in which we wrote rules of origin conditions don't work now with rising prices of components. This is not a UK problem. It is an EU-UK problem. It works both ways. So both sides are actually interested in looking at what we can do in order to resolve that. The trade and continuity agreement is up for review in 2025. We're looking to see what we can do in advance of that because, as you know, there are lots of global headwinds that are affecting the car industry.
So that was just over a week ago, but there have been no breakthroughs, and it's potentially a big problem for the UK. Some 780,000 people are employed in Britain's automotive industry. They produce almost 1 million vehicles a year, and 8 out of 10 cars are made here, are then exported. Well, let's discuss all of this with Bloomberg's global car czar. He's Craig Trudell, as well as Michael Dean, a senior European automotive analyst at Bloomberg Intelligence. So thank you both for joining us. First, I mean, this seems like a little bit of a nightmare, right, to deal with and try and puzzle everything together. How serious, Craig, are these post-Brexit rules?
Yeah, I think this is a classic sort of tragic irony of this desire to get out of the EU led to some of the same complications and bureaucracy that was sort of what precipitated a desire to leave the EU, right? So this was a matter of leaving a customs union that made trade simpler and uncomplicated. As we heard from Adrian Hallmark, the CEO of Bentley, they became much more complicated, and it's going to be costly. And there is a sort of question of where do you want to direct your investment? A place that's low cost, less complicated, or higher cost and more complicated? It's a pretty simple question.
Yeah, so how can they change? I mean, I know that, we can spend 2 hours saying why were they agreed in the first place, but if they were agreed, pre-Brexit, is there any wiggle room on how to change things?
I think certainly. You've also got to remember that although we export 50% of UK production to the EU, 65% of UK sales come from the EU. So it's an issue for both sides. So that means there should be a willingness for both sides to come to an agreement.
I mean, how much does this have to do with also costs coming up, that it's almost a perfect storm for everything?
Yeah, that's true. So 40% of a battery electric vehicle is the battery itself. Oh. So given the increase in metal costs that go into a battery, this has become an issue, particularly as we transition to battery electric vehicles over the next few years.
And the costs are not going to go up. Can I just spend a moment in saying the sartorial elegance of our car, experts is, it's a white shirt, it's a very classy white shirt with a very classy blazer for both of our experts. But when you go back to costs, I mean, these are not going to go down anytime soon.
Yeah, I think there's also a challenge of energy costs, right? It is a very energy intensive business, making batteries. And so this is a case where, where you're going to localize battery production is a big question, as Michael referred to. It's a huge part of the value of electric vehicles. And we have a lack of battery production in the UK, and not a whole lot of reason to invest in the UK when energy production is higher, when it's difficult to get to procure labor. There's a lot of complications here, and these are big, heavy components that are hard to transport from mainland Europe to the UK in a sort of cost-effective and easy manner.
But Greg, how much is this because of the automotive industry or batteries or some of the components, and how much of it is actually a struggle overall for any manufacturing in the UK?
Yeah, I think that's a big question. I do think that, in speaking with Adrian Hallmark at Bentley recently, he's talked about this issue of the challenges of immigration, and finding people to work in factories. So I do think that, the UK does have a lot going for it in that it has this long history of manufacturing a lot of cars. And it's a question of whether or not, the sort of retained expertise and experience is enough to make up for some of these other, aspects of the industry that have been the sort of reasons why so many manufacturers have been moving elsewhere.
So how do you revive this, right? I mean, and this is, I guess, what we're trying to figure out. And you write about this every day, as do you. When you look at the blueprint of how you fix this, does it have to start with batteries? Does it have to start with other components? And is it actually inward investment coming into the UK?
Yeah, I think batteries are key. So if you look at UK production, 30% comes from Nissan. They have a gigafactory, and they're expanding that. So they have production in place for the transition. JLR accounts for 30% of UK production. So if press speculation is correct, the next gigafactory from JLR will come to the UK. So that would be a massive positive for the UK and would accommodate 60% of their battery needs in the future.
Yeah, but Michael, so JLR is owned by Tata. They're looking at doing an agreement with the UK. How much of a struggle is it if it doesn't come through?
Yes, a massive struggle if it doesn't come through, because they do need these batteries. Yeah. And because of these rules of origin, it's going to be an issue, and they will become uncompetitive if they're going to sell to Europe in the future.
But again, and I know this is a difficult question, but to you both, do they need this deal to, for batteries and automotive, or do they just need it so that it says, look, Britain is open for business?
A bit of both. So, subsidies are key. So there's been huge headlines about the Inflation Reduction Act in the US attracting battery plants over there from EU companies. So subsidies are key, and the UK government has to back UK businesses in terms of battery production, and that should be the case with Jaguar and Land Rover. Okay, is it looking good? I mean, the government, again, we have a government that's a little bit in a tricky situation because they have to fight a lot of fires, and we're not sure they're in charge for much longer.
I think what we absolutely need, just to follow up on what Michael's talking about, is an industrial policy, and that's something that we've consistently heard from car maker executives and current and former, that the UK lacks an industrial policy to justify keeping production here. especially in light of the Inflation Reduction Act that really sort of raised the stakes and is going to force the hand of the government to really step up and support and save this industry.
At the same time, I guess, the industry that was really in doldrums during COVID has not only recovered, but luxury sales of cars are doing really well.
Yeah, and I do think that there is absolutely a place for companies like Aston Martin and Bentley to maintain production in the UK, even if it means even if we are unable to attract much battery investment. We've heard Bentley talk about, being able to tap Volkswagen's supply chain, using batteries from mainland Europe that would apply to that rules of origin and help hit that threshold, and not necessarily need to localize battery production here and still maintain their presence in Crewe as well.
I mean, it's amazing, actually. It does employ 780,000 people in the UK, this industry. It's a lot of people. And if you look at, of course, the targets that the UK has set, Michael, the UK wants basically to be hybrid by 2030 and then completely electric by 2035. I mean, that's a huge amount of cars that need to be made and then driven.
Yeah, it's going to be very difficult. You've already seen the EU dialing back, or some EU countries dialing back on when they're going to ban the combustion engine. In terms of BEV market share, it's about 15% in the UK. That compares to the 13% in Europe. So we're still a long way away from this being an issue, certainly not in the next few years, but certainly in the second part of this decade. We need better battery supply, but we also need better charging infrastructure. So that could be another part of the puzzle that's holding the transition back.
I mean, that seems hard, right? Because I don't know how long it takes. First of all, you need the copper and the things to make it. And again, we don't have an industrial policy, and the Chinese have really thought about this, maybe more than G7 countries. But two, how long does it also take to put these charging stations in place?
Yeah, it takes a long time because you need the people in place, you need the finance in place, you need planning permission. They're very expensive. So globally, there's 2.7 million public chargers in place, only 600,000 in Europe. We think you need 2.5 million by the end of the decade if we're to meet government targets. So they've got a long way to go, and we're probably putting in about 150,000 chargers at the moment. So that needs to double if we're going to meet these targets by the end of the decade.
So industrial plan now is basically the call for action for the government, right?
Yes.
We just need an industrial plan.
Yes, and it's long overdue. I do think that some of the warnings that we've heard recently, maybe one sort of silver lining of this, talk about, doom and gloom will sort of wake up leaders to this idea that, they can't continue to allow this industry to languish, and do need to come up with an answer to what the IRA, what's happening with the IRA, and in the EU to answer the IRA in places like France and the rest of Europe.
Such an important conversation. Thank you both for joining us. Bloomberg's global car czar, I love saying that, Craig Trudell and Michael Dean from Bloomberg Intelligence. Now, speaking of an industrial plan, we're also getting UK manufacturing PMI coming in a little bit better than expected at 47.1. Remember, anything below 50 is still in contraction territory, and UK firms are expected to raise prices some 5% in coming year. That's the very latest forecast from the Bank of England. Coming up, batteries and Brexit. We'll talk more about the state of Britain's electric vehicle industry and why the UK is being overtaken by others. This is Bloomberg.
The tag on the product may read "Made in the USA," but the sign on the CEO's door often says "Made in India." Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Business Week Radio. Live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
This is Bloomberg.
Economics, finance, politics. This is Bloomberg UK. I'm Francine Lacqua here in London. Welcome back to our deep dive on the future of the UK car industry, of course, in particular, electric vehicles. Now, joining us now is Caspar Rawls, Chief Data Officer at Benchmark Mineral Intelligence. We love a data guy because this is what we do at Bloomberg. So you track and measure and actually see where the soft spots or the blind spots of the UK government are. How are we doing on electrifying some of the batteries in the car industry?
Yeah, good morning, thank you. Yeah, in terms of the UK government, we're not doing too well. We've really lacked proper, let's say, electric vehicle or lithium-ion battery policy so far. And when we look at other countries in particular, not just in Europe, so in Europe, Germany, Hungary have been doing very well at attracting investments in the lithium-ion battery supply chain, but other global regions as well, particularly Asia and China.
But so is it too late? And is it actually a lack of capital? So it's a lack of big investors? We know that Bill Gates, for example, is giving a lot of money in the West Coast to try and get this done. Or is it a government policy?
It's probably not too late, but to catch up, you need to put more money on the table. So the UK needs to, or the UK government needs to show support for a full lithium-ion battery supply chain. I mean, to date, so far within Europe, a lot of the focus has been what we'd term the downstream, so kind of the battery in the electric vehicle. But also we need to think more about the upstream, the critical minerals. So where are you going to get those minerals from? Can you do that in the UK? Probably we won't be self-sufficient. So thinking about partnerships with other regions to get the minerals to feed the supply chain and all of those plants.
So, Caspar, is it the model of, for example, Germany? Do you have to grow this in-house? So do you have to have, UK technology? And we know that we have top universities, so we could be able to do this if you put enough capital behind it. Or is it about the UK government attracting, for example, Elon Musk to have a factory in the UK?
It's a mixture of both. You definitely want to attract what we would term at Benchmark the tier 1 cell manufacturers. So there's actually only kind of 9 companies globally which can supply electric batteries into every global region, electric vehicle batteries into every global region. So you need to kind of bank on those companies, the ones with the experience and the technology to supply EVs. It's very challenging to get to that quality, but also homegrown talent as well. So supporting industry, supporting new UK companies which are looking to develop battery technology.
What I also don't understand is some of the earths or some of the metals needed. It's copper, it's certain parts of like iron, I think, I mean, things that actually British listed companies do. Right, Glencore is very present in the space. You have BHP.
Yeah.
Is that a missed opportunity in actually trying to do some of these deals, or does it not make a difference where they're listed?
It probably doesn't make a difference where they're listed, just because these critical minerals are going to be in such short supply. So primarily that's lithium, and that comes from various different global regions, and therefore you get many different types of companies.
Mainly China, right? I mean, they locked and loaded that.
Yeah, so lithium chemicals, a lot of lithium chemicals come from China, but that's the refined type of lithium. A lot of kind of the lithium in the ground, let's call it, comes from Australia and South America. But also you need other minerals. You need nickel, you need cobalt, manganese, you need iron phosphate for LFP batteries. So it's very important to ensure that you can either support industry to go out and acquire those minerals, or the main way would be to attract companies who buy them and ensure that they're going into the plants in your region.
So, Caspar, if you're the UK government now, and of course you're dealing with the Inflation Reduction Act in the US, where we're also seeing possible a lot of investment into greening the automobile sector going stateside, and you have, of course, the plan of Ursula von der Leyen in Europe, you need to be better and bolder to make sure that investment comes here.
Yeah, you need to compete at that level, and the amount of money that's been put on the table for the Inflation Reduction Reduction Act in particular by the US government is a scale that we've not seen before. It's many hundreds of billions, potentially trillions of dollars that will be in terms of support for a full lithium-ion battery supply chain from the mining, the critical minerals through to recycling. So it does up the ante as as the UK government looks at this. But as I say, it's probably not too late, but something needs to happen, in the very near future to ensure that it isn't too late and we don't lose those existing jobs which are tied to the auto sector in the UK.
Are we still in the infancy of batteries? Is it what like solar panels were 15 years ago?
Yeah, I mean, definitely in terms of the scale, we're in the kind of Ford Model T era of the lithium-ion battery supply chain, so at the very bottom of the hockey stick curve. So yeah, there's still time. The demand for these batteries is going to be growing something like 25% CAGR beyond the end of the decade. And so there's a lot of scope to build out the supply chain in that time frame, but it becomes more and more challenging as time goes on. And those kind of very sticky strategic relationships between the car makers and the battery makers get cemented over time.
But it's also the technology, right? How much is the technology changing? I know that and how you recycle them, like the whole ecosystem. How much of a question mark does it still have?
Yeah, I mean, definitely the technology is changing all the time. So the lithium-ion we have today is better than the lithium-ion we had 5
years ago, I guess.
Yeah, or even 2 years ago. It changes very quickly. But, that it's changing with consumer needs. So there's still a lot of scope to see the supply chain change, the technology change that we use in the vehicles, and then next-gen technology as well. So you always need to have one eye on the future of the kind of next type of batteries that will be going into EVs and storage as well.
And Casper, when you look at the data, consumers want this, right? Like consumers are ready to buy the cars as long as they have the infrastructure.
Yeah, I mean, the infrastructure is important. Obviously, there's range anxiety, so having access to charging. But also, what's challenging is we've seen prices for critical minerals. At the peak last year, lithium prices were 10x where they were just before the pandemic. So it's also managing costs. So being able to build out that scale to keep costs low, to enable more consumers to be able to afford electric vehicles. At the moment, they're still relatively expensive.
Casper, thank you so much. Casper Rawls, their Chief Data Officer at Benchmark Mineral Intelligence. Now, coming up, Made in Europe, we'll ask what the EU is just doing differently to the UK to get ahead in the EV battle. That's next, and this is Bloomberg.
To the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. The names that move markets are on Bloomberg.
The regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics. What I see is a banking system that overall is well capitalized, still has very solid earnings, but, we're monitoring the situation very, very carefully.
Nobody covers business like Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
So I think the main thing we did, which was not so easy, was to stick with our process. And then it kicked in big time in the last really 2 years.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Economics, finance, politics. This is Bloomberg UK. I'm Francine Lacqua here in London. Now, this morning we've been exploring the state of the UK car industry, threatened by Brexit trade rules and at risk of falling behind in the switch to electric. Now, while the UK has only had a handful of battery plants, Europe has at least 35 up and running or under construction. Well, let's bring Bloomberg's Elizabeth Berman from Munich. Elizabeth, good morning. Why does Europe seem to be so ahead of the UK when it comes to batteries?
Yeah, it's a bit of a relative question. If you look at the UK, they've been distracted since 2016 with Brexit. There's been a high-octane political drama, successive business secretaries, successive transport ministers. So there's not really been much of a line on developing an industrial policy. And when you compare that to Europe, you have to look back to around 2018, when the race and this realization to try and close this huge gap in the value chain in EVs, that really started to take shape then, when France and Germany formed an alliance. The whole thing became an election issue even in Germany, like this push to build lots of battery plants. And then it reached the EU level and things started to take shape. And today we're really seeing the first fruits of these in the shape of actual plants that are producing, that are up and running. And just this week in northern France, Stellantis, Mercedes and Total inaugurated the first stage of their plant there. And then we also have in Sweden Northvolt, which is up and running. But this makes it looks good versus the UK. Versus elsewhere, Asia, there's still a lot of catch-up to be done.
But a final thought then, Elizabeth, maybe on the post-Brexit trade rules. The Stellantis chief executive has called them a lose-lose situation with both the UK and the EU. Why can't the two sides work out a solution?
Well, first of all, Stellantis is right. The European supply chain is not ready to meet these rules of origin. It's also to do with rising raw materials prices that are making batteries even more expensive. And in terms of trying to find a deal, as we've heard, the car industry is very much united in pushing out the threshold level to a later date. From the UK, we've heard the same. Where we've had notable silence so far is from the EU Commission. I can't speculate on their readiness to reopen the deal on this, but there are, of course, also a lot of smaller states in the EU that might want to benefit from multi-billion investments, notably Hungary or Slovakia, where you already have lots of car plants.
Elizabeth, thanks so much. Bloomberg's Elizabeth Berman there on the EU side. Now, be sure to subscribe to Bloomberg's In the City podcast, also that I host alongside Dave Merritt on Apple Podcasts, Spotify, or wherever you get your podcasts. Every Thursday, new episodes.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, you know, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. Because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because this is really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
This is Bloomberg Surveillance Early Edition with Anna Edwards and Kriti Gupta.
It is 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. New inflation data this hour may determine whether the ECB keeps hiking interest rates. Meanwhile, Fed officials say they're in favor of a June pause, but more hikes could follow. The US debt limit deal moves to its next phase. The deal now heads to the Senate after winning House passage in a rare moment of bipartisan accord. And AI enthusiasts getting a reality check as shares of Nvidia and other major players slip after a powerful rally. Welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie, stepping in for Anna Edwards in London with Kriti Gupta, of course, in New York. Kriti, a trifecta then of positive catalysts, at least for now. Slightly better than expected China data. The Fed, of course, hinting, at least some officials, at that pause in June. And then the debt ceiling deal getting past the hurdle of the House.
Yeah, the focus shift that you're seeing so quickly from this idea of the debt ceiling no longer being the macro narrative to very quickly going back to the fundamental story of growth, that is showing up in the markets all around the world, I would argue, especially when you're talking about the momentum behind futures. That defensive bid that you saw in the tech space kind of simmering down just a little bit. Futures up still about 0.2%, but again, really lacking that conviction. And if you look cross-asset, you are seeing similar signs. Again, the idea of that is inflation really fully targeted to the full extent by the Federal Reserve, and how much further do they need to go? That sentiment really showing up in the bond market. Two-year yield hitting 4.44, inching closer and closer to 5%. So really speaks back to that question of what is the terminal rate at the end of the day. Already seeing a 5 basis point move higher. So some bond volatility before trading has really even fully kicked off stateside. Bloomberg Dollar Index taking a little bit of its cue from what's going on in yield, about unchanged at the moment. But remember, earlier in the session, really tick by tick following what the bond market was telling it. And of course, Tom, as we talk about that de-risking around the world, perhaps gold not really the trade du jour. You are seeing the precious metal down today, down about 0.3%, trading at about 19.55. If you were worried about inflation, if you were worried about a recession, you would think the commodity space would get a bigger bid. And yet, Tom, we're just not seeing that.
Well, on those inflation concerns, the redhead's crossing right now. We've been waiting for this in terms of Eurozone inflation, and the headline number coming in slightly below the estimates, but the importance around core inflation and that print as well coming in slightly lower than the estimates. So this is good news, at least on the level, and at least on the surface level for the ECB. We'll have to have a look to see if there's a change in terms of market pricing around the next steps. June seems pretty certain in terms of another hike from the ECB, but really there is a question mark over July. So consumer prices for the euro area then coming in at 6.1% year on year. The estimates were for 6.3%. And here's the core number then, 5.3% year on year. The estimates for 5.5%. So 5.3% year on year for core, below the estimates of 5.5%. And again, it does suggest that inflation is heading in the right direction, even as those ECB officials say there is more work to be done. We will check in on the market moves then with a particular focus on the euro dollar and also those sovereign bonds. Across the equity space, you have seen an uplift, snapping 3 days of selling pressure across European equities. You're gaining 0.9% across the benchmark here now. Part of that is the China data, the Caixin survey. It focuses on private and smaller companies, and it's diverged from the official picture. So it's a mixed picture when it comes to China data, but for the moment there's a bit of relief, and you're seeing that in sectors like autos, and that's certainly lifting European stocks. Euro dollar 106, it's flat, but you're at levels last seen since March for the single currency. Anglo-American, we pulled this out for you because of the lift that we're seeing in terms of copper and iron ore prices, again tying to the China data, gaining 1.7% on the back of that. And Doc Martens is an idiosyncratic story, really, but this is the famous shoemaker here in the UK, the bootmaker. Full-year earnings estimates coming in, full-year earnings coming in below the estimates, and a cautionary note from the analysts that maybe the peak for this brand has been baked.
Again, is not that surprising when you look at the data that we had from a number of national prints yesterday. Obviously, yes, both numbers are still above the European Central Bank, but what really matters is the trend here, and it points to a cool down, actually better than expected when it comes to the survey, this cooling down in May. Now, the real issue here, especially when you look at core and headline inflation, what the European Central Bank really wants to see is this determination, the monetary policy, this hiking cycle, the most aggressive since the creation of the euro, is now really feeding through on a persistent medium-term basis. That this is not just connected to energy. What we've seen, and we've seen this repeatedly over the past few months, is that as soon as energy prices go down, headline inflation falls. But what they want to see is almost this intrinsic proof that this is sustainable and will put inflation now on a more medium-term direction to hitting that 2% goal. Overall, of course, the numbers, you could argue it is welcome news. It will point to this cool down. We know there is a meeting in 2 weeks' time, and the data will be key. The European Central Bank repeating now many times it is mega data focus. They focus on the pass-through of monetary policy too, and they really monitor that core print coming in at 5.3% for me.
And of course, that data, key focus for the ECB's next meeting coming up on June 15th. Well, Bloomberg TV had a very special guest earlier on air. We spoke exclusively to former ECB President Jean-Claude Trichet earlier to mark the central bank's 25th anniversary.
25 years is a quarter of a century. And we started the ECB and the euro in an environment of great pessimism. As was said a moment ago, it was the, I would say, boldest endeavor. I would not say experiment, because it seems to me it's much more than an experiment, but the boldest endeavor in that domain.
Well, the boldest endeavor, Maria, working out, wouldn't you say? Talk to us about what the ECB is going to do with all the data this morning.
Look, and on top of the data, by the way, that we got today, the ECB is expected to put out new projections in June, so that will also be important in terms of the narrative here for inflation. And look, today we heard again from the Vice President of the European Central Bank, Luis de Guindos. He was also on Bloomberg TV yesterday and repeated at this point, the ECB has probably entered what is the final stretch of this hiking cycle. It's also notable that he did say it does seem that at this point, and this is his opinion, obviously we know the Governing Council entails a number of views, but he says in his view and his opinion, 25 basis points will be the new norm going forward. Again, this downshift has already happened. There was a question as to whether it would be sustained in time. The words from the VP of the European Central Bank would signal that, in his opinion, yes, from now on, it is 25 basis points. Now, when it comes to the meeting in June, the market is very well calibrated that there will be another hike, but the serious question is what happens next? How many more hikes could be to come if the ECB decides that should be the way? Or actually, if you look at the market, some of the cumulative basis points hikes that were priced in, the 50 basis points, that reversed a touch yesterday, signaling there is now an open debate as to what happens after June.
Yeah, a question that we are starting to explore stateside as well. Maria Tadeo over in Brussels, we thank you as always for walking us through that crucial data. And from Brussels, we come right back to Washington. The House has passed the debt limit deal created by President Biden and Speaker Kevin McCarthy that would impose restraints on government spending through the 2024 election and avert a destabilizing U.S. default. McCarthy spoke after the vote last night.
Tonight, we all made history because this is the biggest cut and savings this Congress has ever voted for.
Joining us now, Jack Fitzpatrick of Bloomberg Government. Look, a historic moment over in Washington. Jack, what comes next? Isn't the true hurdle in the Senate here?
Not necessarily, no. I think the true hurdle was getting a deal between the president and the Speaker of the House, and then the assumption was always if you can get a Democratic president and a Republican speaker to get a handshake deal, you're probably fine in the Senate. It needs 60 votes in the Senate. I guess the last remaining test is not so much the Senate whip count, but the timing of a Senate vote, because this is a chamber that moves slowly unless it has unanimous consent for a time agreement. If all 100 senators agree to schedule a vote before the Monday deadline, then we're in good shape. So there are a few senators talking about what they might want in terms of amendment votes or something else in order to agree to a speedy vote. We haven't heard from anybody who seems like they're going to try to burn the place down. But there are probably going to be some amendment votes that are destined to fail. And even some, for example, Senator Lindsey Graham says that in order to give permission for a quick vote, he wants answers about the possibility of further defense spending that goes over the caps set in this bill. So Congress is already trying to find ways around the spending constraints. But long story short, it does not seem that anybody's going to try to delay a vote. And it does seem to be in pretty good shape heading toward a Senate vote.
So, Jack, as the dust appears to settle on this deal, who comes out best? Who is best burnished or indeed wounded by this deal?
Nobody's terribly happy, which is probably a good sign that it is a true compromise. Republicans got more out of this than Democrats, certainly. This is a list of things that conservatives wanted. It's not as conservative as they wanted, but they managed to get some spending constraints in a Democratic administration. They managed to tighten some work requirements for SNAP nutrition aid eligibility. There's really nothing particular in here that Democrats proactively wanted that they got. Although if you compare it to the original Republican bill, there were a lot of concessions made from Republicans just in terms of fewer spending caps, fewer spending cuts. So it's certainly a compromise, but it's one based off of Republican principles.
Well, Jack, we know that in the short term, things look like they are just fine. But of course, this is going to then push ahead to the 2024 presidential election and what comes right after. Talk to us about, in about a year and a half's time, January 1st, 2025. This feels like yet another big issue for whoever decides to, or whoever is elected to office. Jack, talk to us about the long-term debate on the debt ceiling as just kind of a function of this saga that we go through every couple of years. What is the feeling in Washington about whether it's even useful?
A lot of Democrats would like to get rid of it. That's probably the mainstream position among Democrats. They have not had enough support to get rid of it, or at least they didn't have enough support to get rid of it when they controlled both chambers. I think people like Senator Joe Manchin generally seem to think that a spending cap deal like this through the debt limit is a good thing, but many Democrats would like to get rid of it. Some Republicans are interested in maybe tweaking the process so it's a little bit less focused on brinkmanship and getting us close to a deadline. So there are some big questions being asked, but it's been a number of years that Congress has questioned itself about its budgeting process, about the debt limit, and they have not made major changes. So that's something that's simmering. I don't know if this fight brings it to a full boil, but there are questions being asked about whether lawmakers really want to go through this again.
Okay, Jack Fitzpatrick on this bipartisan deal and looking ahead to some potential challenges that may rear their heads once again when it comes to US politics of Bloomberg government. Thank you. Now to the tech space and NVIDIA losing some ground in the pre-market after a record, of course, AI rally. Some investors have expressed concern over high valuations. Joining us now to discuss is Bloomberg's Alex Webb. Alex, do we get the sense of a wry smile forming on the lips of Cathie Woods? What do you make of this?
It is interesting because actually this $1 trillion market cap number, which is kind of, an invisible hurdle, doesn't necessarily mean all that much. We've seen something similar when other companies have tipped it. When we've seen Amazon get to $1 trillion for the first time, Apple go to the first time, we saw a bit of a sell-off in the day or two. So following that, it appears to be a certain amount of profit taking. If you look more broadly, though, at AI, people aren't quite sure how to read it. Is NVIDIA the best play, and it's still got lots of legs in it? It's quite hard for anyone to tell because we don't quite know how demand is going to materialize as we head into next year and year after. But also, they've been burned before when it comes to things like crypto and Web3. This feels like a different set of technology where it has immediate applications that lots of people can see, but there's a bit of hesitation.
And we should talk about another major tech name, and for those of you who kind of watch the Dow, specifically a major Dow component, Salesforce, Alex, also edging lower in the pre-market. Their results disappointing investors. We didn't get that traditional artificial intelligence phrase dropped in anywhere that we did for some of these other tech companies. What's the story with Salesforce?
It's a fascinating equity story at Salesforce because we've really seen them pivot away from being a growth stock and focusing on profit. And the number that seemed to have disappointed investors, particularly yesterday, was what the company calls current remaining performance obligations. Essentially, it's its order book in the broadest sense. And that was a little bit low what the market was expecting. We've seen the valuation as a multiple of its blended forward earnings for Salesforce come down, even as the stock has remained relatively robust. But, in sort of 2019, 2020, it got to 70 times its forward earnings. It's come right the way down to 29 times its forward earnings. But that's partly because the earnings themselves have come up massively. There's a real focus now on profitability. They're not investing profits as readily in gaining market share. And perhaps there's a little bit of hesitation from some investors who were still in a growth stock and not necessarily in what this stock is now becoming.
Okay, Alex Webb on Salesforce and NVIDIA, of course. Thank you. Now, coming up, we're going to speak to Royaka Ibrahim of BCA Research on why she sees a potential monetary policy mistake looming in Europe. And The View from Lazard. Peter Orszag says, do not bet against America.
I would not short the United States. There are a lot of ongoing strengths that we have despite a very polarized political environment.
More from our interview, of course, with the incoming CEO of Lazard. That is ahead. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
The names that move markets are on Bloomberg.
The regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics. What I see is a banking system that overall is well capitalized, still has very solid earnings, but we're monitoring the situation very carefully.
Nobody covers business like Bloomberg, your global business authority.
I am in the camp increasingly coming into this meeting thinking that we really should skip, not pause.
Skipping a rate hike at a coming meeting would allow the committee to see more data before making decisions about the extent of additional policy firming.
Okay, that was Philadelphia Fed President Patrick Harker and Fed Governor Philip Jefferson. Let's bring in Bloomberg Markets Live editor Noor Al-Ali. In the context, the importance around, of course, Jefferson is that he's seen as something of a wingman for Jay Powell, who previously, earlier in the month of May, suggested that June was going to be a pause. That idea, that debate now seems to be solidified. You're going to get a pause in June. Is it going to be a hawkish pause? And where do you expect the next steps to be?
Well, it really depends on the jobs data, right? I mean, we are seeing, or it's expected to moderate slightly, but it's still quite healthy in terms of an economy that needs to still see jobs the jobs market become less hot or less tight as it is right now. You also still have, core inflation still very much higher than the Fed's target or where it's comfortable with. And keep in mind, we have the lagged effects of monetary policy really starting to seep through. We've got the most aggressive tightening policy from the Fed since the 1980s. It's going to take some time. So a pause, although that is starting to seem like a campaign from the Fed, isn't it? It seems a bit more in line with what they're trying to get the market to position themselves for. So let's see if the market bites.
Well, speaking of biting, I mean, the market has been pricing in cuts for a very long time, now pivoting to a hike. But it feels like at the core of the story is this growth idea, something that's reflected very largely in the commodities market, specifically stateside as we look at NYMEX crude, for example. I think we've got a term for our radio audience. You can find this on GTV Go on your Bloomberg terminal, essentially showing that you are looking at WTI falling below $70 a barrel, and it's kind of been there for, I want to say, the last 6 months or so, really testing that level. Nor, when we're talking about growth concerns, where does the investor base really stand?
Well, look, for oil, it's really complicated, right? I mean, oil was very much the inflation story after the pandemic. You also had, OPEC plus globally and the global benchmark really contribute to that tightening supply picture. But also now you have that straining of potentially the supply picture or the demand picture out of China. We've had factory data earlier out of China, point to initially some kind of recovery, though the recovery in China is still very much in question. Obviously, you've had diesel really struggle as well. Natural gas supplies and all that stuff really has taken a hit because you've had a milder weather. You've had, the trucking industry still very much subdued. So that seasonal tick in demand that you would particularly expect this time of year is not really there. So all eyes are really turning now to OPEC. They're meeting, this weekend. It's going to be a very exciting time for the oil market. Will they be able to support the market? And if not, what does that mean for prices? And I think that's something that the market is positioning themselves for.
With Brent at $72 a barrel, WTI at $68 a barrel, and that Goldman Sachs call of $95 a barrel by the end of the year looking far away. Noor Al-Ali, thank you very much indeed on the commodity complex and rates as well. For more market analysis, of course, check out MLive Go on your terminal. This is Bloomberg.
analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Young adults are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new Bankrate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
Now keeping up to date with news from around the world, here's the first word. Ukraine's capital was hit by missiles overnight. Kyiv's mayor says at least 3 people were killed, including 2 children, by debris. NATO foreign ministers will discuss Ukraine's bid to join the military alliance at a 2-day meeting in Oslo today. Meanwhile, Ukrainian President Vladimir Zelensky made an unexpected appearance at a summit in neighboring Moldova. The summit is taking place less than a dozen miles away from the breakaway region of Transnistria. Zelensky says he will hold bilateral meetings at the European Political Community Summit, where he will propose setting up a, quote, coalition of patriots. Elon Musk's private jet has departed Shanghai, wrapping up his first visit to China since the pandemic that included meetings with senior government officials and a late-night visit to Tesla's Shanghai Gigafactory. In a video released by Tesla's China team, Musk was shown waving to the workers, then thanking them for being at the factory late at night. He also congratulated the staff on their, quote, amazing work. Coming up on the program, Ruqaiya Ibrahim of BCA Research joins us next. We're going to talk about everything from these markets to the economy. Very quickly, did the focus turn from the debt ceiling debate to simply the idea of growth, of inflation? Is the fight of inflation really over? We're going to ask Ruqaiya and get her insights on just how to play this market. Stick with us. This is Bloomberg.
most actors are thrilled if they have one part like Rocky in their whole career.
Yeah.
You had another one, Rambo.
Yeah.
Now, Rambo was not something you created, is that right?
No, Rambo was a novel by David Morrell. And I was the 11th choice. Everyone, it was like, I don't know who was next after me because they had gone through everyone. And it passed, including 3 different directors. So this had become sort of a pariah of sorts. The first time you go in there, Rambo was, in the original screenplay, was horrible. He was a psychopath. He killed children, he killed fishermen, this and that. So I said, if I'm gonna get involved with this, I see the character going on beyond this. And they said, what do you want to do? I said, I want to rewrite the screenplay. And I want him to go right to the edge of violence, right to the point where he's being pushed, but he pulls back because, similar to James Dean in East of Eden, he wanted to be accepted back into the family of man.
So if Rambo got in a fight with Rocky, who would win?
Rambo.
Rambo.
Easy.
Because
not even a fight. Unless it's in a ring. See, first of all, Rambo is a killer, for real. He's almost a psychopath when that switch flips. Rocky is a good guy. You know, he has mercy. The other one has no mercy.
The top names at the Fed are on Bloomberg.
Right now, if you had to tip the scales, the next move is going to be an increase or a cut. It's pretty heavily weighted to the increase for me.
Nobody covers the Fed like Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Euro area core inflation eases, though the retreat is unlikely to stop the ECB from raising interest rates further. Meanwhile, Fed officials say they're in favor of a June pause, but more hikes could follow. The U.S. debt limit deal moves to the next phase. The deal now heads to the Senate after winning House passage in a rare moment of bipartisan accord. And AI enthusiasts get a little bit of a reality check as shares of NVIDIA and other major players slip after a powerful rally. I'm Kriti Gupta in New York with Tom McKenzie stepping in for Anna Edwards over in London. Look, Tom, the kind of debate around the markets in terms of what is actually driving the macro narrative is crucial. We went from debt ceiling to growth. Is that what you're seeing in Europe as well?
Well, certainly the data out of today for Europe is looking a little bit more favorable. Manufacturing data for the likes of Germany and France came in a little bit better than expected. And as you said, inflation is moderating and importantly around core. So for today, at least, it's a little bit brighter in terms of the data. And then we're snapping 3 days of losses across European equities as we also weigh up the optimism around China. It's a bit of a mixed picture, but the smaller survey, the survey focuses on those smaller businesses, the private businesses, the Taixing survey came in better as well. So that's also fitting into the uplift across European stocks. 0.88%, euro dollar 106 as we weigh up the next steps for the ECB. As Maria today has been explaining, June seems pretty baked in, but it's July that remains the questioning point now. In terms of the lift that you're getting from the China data, that's certainly been seen in copper and iron ore. The last time I checked, iron ore prices were up about 4%. So that's a benefit for the likes of Anglo American and the other miners, gaining 1.8% on the back of that. UniCredit, the banking space, the banking sector, really leading the charge as well. One of the leading, if not the leading sector in the session this morning. UniCredit is part of the mix there. It's also received an upgrade. 2.9% is the upside for that Italian lender. Kriti.
And certainly some sentiment you're seeing kind of bleed into the stateside story as well, Tom, because you are seeing green on the screen when it comes to futures, but I would argue with just not as much momentum as you're seeing on the other side of the Atlantic. Futures are higher by about 0.2%. And again, to your point, it does speak to the idea of, all right, well, is the fight on inflation over? But I have to say there's an extra dimension to the U.S. story, which is the earnings story. Specifically, as we talk about those growth concerns, now we're starting to kind of nitpick through the earnings story of companies like Salesforce, for example, the major player in the S&P 500 and the Dow, and just how much growth and just how much business investment you are seeing from some of these major corporate players, especially in the light of the big AI kind of craze that we just saw in the markets, justified perhaps by some of the money going into that. So that's going to be a theme we explore in just moments. 2-year yield, 444. You are starting to see yields come higher, again, talking about the inflation story and just how hawkish the Federal Reserve could get as the market kind of prices in a July hike over a June hike. So that's going to be interesting. The pause or skip debate coming back to the forefront. The Bloomberg Dollar Index, at least directionally, following the story of yields, although on the surface unchanged at the moment. So really keep an eye on how that speculative positioning and the FX story really has a ripple effect, not across just equities, but across commodities as well, specifically in gold, where we are seeing some of the momentum kind of ease now that the debt ceiling debate is in theory over. 1958 on the precious metal, Tom.
And just looping back to the inflation story out of Europe, Madame Lagarde, of course, the president of the ECB, a couple of lines at a speech that she's giving right now. Inflation is too high and is set to remain so for too long, says Madame Lagarde. Still have ground to cover on rates. So a reminder that they do believe within the ECB Governing Council, we know this is a live debate, but you are hearing uniformity in terms of the need to go a little higher. The question is how much higher, and is July still in play? Let's bring our next guest then, Ruqaiya Ibrahim, Daily Insights strategist at BCA Research. And Ruqaiya, thank you for joining us. I want to start and look back to DC and the politics of the US. Let's assume, if we can, that the debt deal has been done. It's past that crucial hurdle of the House. It goes to the Senate. But if we can make the bold assumption that it's a done deal and switch our focus to the issuance then of what some are estimating is potentially $1 trillion of debt from the Treasury to refill those coffers, how does the market absorb that? What are the strains that you're looking for?
Yeah, well, definitely the deal does remove this uncertainty that has been haunting markets over the past few weeks. So that's definitely positive, and it's going to be positive for risk assets. But I think the overarching picture here is that, I think the focus is going to quickly shift to, the macro context, which is still that inflation is too high, that the central banks are still, monetary policy is still restrictive. And that's the overarching macro picture that is going to weigh on markets going forward. Now, in terms of bond markets, I think that what this means is that the continued tight monetary policy. The Fed most likely is not going to hike in June and probably not in July as well, but it's very unlikely that it's going to cut interest rates at the second half of the year. We've seen markets, remove their pricing of those rate cuts in the second half of the year, but that's going to be something that's going to continue to weigh on equities. And at the same time, it implies that bond yields are most likely going to be range bound for now until we see a greater deterioration in the labor market data, which is then going to lead to the next leg down in bond yields. So I think that's really what matters in terms of bond markets is, what's going on with the central banking.
And the markets have faded those expectations of cuts by the end of the year from the Fed. Does that store up those? We look ahead to 2024, Ruqaiya, does that store up just more cuts that have to come through next year from the Fed?
I think it really depends on what we see in terms of the economic environment. And our base case is that we are likely going to see a recession going into 2024, perhaps in the first half of 2024. And if that's the case, then the Fed is going to definitely, turn to easing. Now, the good news here is that so far what we've seen in terms of the labor market, and this was confirmed by the JOLTS report that we got yesterday, is that the labor market has been quite resilient. So it's, it's been that a lot of the weakness has come in the form of lower job openings rather than a rising unemployment rate. Now, the question going forward is this trend going to continue? If it does, then it does not necessarily necessitate too many rate cuts from the Fed. But if we do see a greater deterioration in the labor market, which is our base case, at the end of the day, the unemployment rate is a mean reverting story, implying that as it begins to increase, it's going to continue increasing. And that likely means that the Fed is going to have to cut interest rates more aggressively next year.
Well, Ruqaiya, let's talk about that kind of thesis of cutting interest rates. If we're of the consensus opinion that this recession in the U.S. and potentially globally is going to be a shallow one instead of a more kind of traumatic one like 08 or 2020, does that really require that kind of easing from the Fed, given that we're coming off of over a decade of kind of this easy monetary policy? Is there an incentive to perhaps not cut at all?
I don't think that there is an incentive to not cut at all. I think that, the Fed has hiked interest rates by 5 percentage points over the past year or so. And so I think that there's going to be an incentive to bring down rates to a more reasonable level. But, I do agree that, that what we're seeing in terms of the likelihood of a recession is a high likelihood of a recession, but not necessarily a very deep recession. And if you take a look at what's happening, for example, in the housing market, the housing market is quite healthy. It's actually rebounded quite a bit since the beginning of the year. And so that suggests that there's no really imbalances there that could be a strong risk for the economy.
Rukaya, so a higher kind of likelihood of recession. But for the equity market, the concept of recession has come and gone. We've also already seen an earnings recession, a technical recession, you name your metric, but they're already looking ahead. Talk to us about the green on the screen we've been seeing specifically in the U.S. stock market. Is this the start of something more sustainable?
You know, what's very interesting is what we've seen year to date is that the rally has been, of course, extremely narrow, bolstered by enthusiasm about this generative AI theme. You know, that could have longer term, longer term optimism on that front could be justified. But, you know, it's probably gone too far from here. And the question is this rally going to broaden out? Most likely not. And, you know, what we saw from the earnings season that you just mentioned is that even though earnings generally surprised to the upside, the reward that equities gave to these upside surprises, which was much smaller than they were in the past, and they penalized the disappointments much greater than they did in the past. And I think that just highlights the uncertain economic environment that's highlighted by, for example, leading economic indicators, the inverted treasury curve. These are all signaling that the recession risk is still ahead. Now, what's very interesting is that analysts are expecting earnings to be to rebound in the second half of the year. However, if you take a look at economic expectations of what's going to happen with GDP, they're expecting GDP to contract in the second half of the year. And I think that there's a mismatch that needs to be resolved there in terms of, is earnings going to rebound, earnings growth going to rebound, or is the economy going to deteriorate? And, you know, my own personal opinion is that it's going to be the latter. I think the economic environment is going to deteriorate in the second half of the year, and that's probably going to bring earnings down with it.
Okay, Rukaya Ibrahim of BCA Research, thank you very much indeed, flagging that split, that divergence between the forecasts on the economy and the projections around earnings, the mismatch, and how that could be a point of concern. Thank you. Coming up, the view from Lazard. We're going to take stock of the investment banking landscape. That is next. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
We've known for a long time that there is a long-term fiscal imbalance facing the United States. So far, it has not caused acute crises, but instead is one of these kind of termites in the foundation type of issue where eventually it will catch up with you.
Incoming Lazard CEO Peter Orszag speaking to Bloomberg's Shonali Bassick yesterday. And speaking of our Wall Street correspondent, she joins us now to take us through some of what's going on in the investment banking landscape. Look, one of my favorite comments from Peter Orszag was, "Don't short America," of course, coming from the American. Let's start with the banking story. What do we know? What do we learn? He has a really unique perspective on that part of the world.
Yeah, he really does, because Lazard has not only a sovereign advisory practice, but they have now also a geopolitical risk advisory practice. And I think that's really interesting, because we are still talking not just about decoupling supply chains or doubling down on certain regions or how to navigate places like China in particular. But, you know, the interesting part of this, too, is you have investment bankers scraping the entire globe for where capital comes from, as well as what is the next leg for deal making. He spurred some optimism also in Europe. And remember, Lazard is one of the bigger independent investment banks in Europe. And so that is another spot where, you know, the economy is showing promising for deals, particularly also private equity deal making, because of not only attractive valuations, but just kind of things kind of coming up to market and open capital markets as well.
I'm glad you brought up the regional kind of bifurcation there, because of course we know deal making in Asia has slowed down a little bit. You mentioned Europe specifically. Is that a temporary situation? Just how bad is the environment when it comes to deal making globally?
Yeah, you have to kind of bifurcate types of deal making. So Lazard is a classical investment bank focusing on mergers and acquisitions. And we talked to a lot of investment bankers this week, so this is a really nice time to take stock before the summer kind of starts off here. Citigroup is another good example of this on global deal making. We talked to Tyler Dixon, who runs their banking capital markets advisory business. And across the globe, he's saying, you know, he's going to China too. A lot of questions, a lot of promise there. But it is too soon to tell when M&A in particular will come back. I think the league tables for the last 12 months is really interesting. Goldman's still on top of the last 12 months, but if you take a look, JP Morgan on the year so far is in the lead. Goldman has been the biggest investment bank on mergers and acquisitions for the last several years, really. So the competition is interesting. One of the biggest deals on the JP Morgan league table this year is Toshiba. So that international footprint is super interesting when you take a look at what's going on. They also have Newmont and Qualtrics. So a lot of competition, but not a deal market that has come back at scale for M&A. A little better when you look at debt capital markets, investment grade and high yields. High yields, Goldman is leading the pack and has risen on those league tables.
So Shonali, that's the picture in terms of deal-making, M&A underwriting. When it comes to the spend on AI and how we tie the AI story to the banking space, the investment banking space, it wasn't that long ago. Well, it was early, 2022, I seem to remember. JP Morgan was getting hammered by some analysts for its massive spend on tech. Is that now paying off for JP Morgan?
It's a good question, because if you look at the jobs that are open, Tom, a lot of them are AI and technology related. And if you think about it, it's an interesting pivot from investment banking, because there are a few banks that use AI and other kind of quantitative techniques, really kind of a lot of other technological techniques, Goldman being one of the bigger ones to do this in places like activism, defense. But if you look at the big spend, places like JP Morgan, Citigroup, Deutsche Bank, places with massive payments businesses, moving dollars in full scale and by the trillions across the world daily, they're the ones with the biggest spend on AI. If you also look at it, it's also consumer businesses, places like BNP in some areas, as well as Wells Fargo, that are spending a lot of money on AI when it comes to things like chatbots, or Morgan Stanley and JP Morgan when you think about their wealth businesses and investing businesses and how clients can be really using generative AI to do different things than maybe they had traditionally done, potentially at scale and at a lower cost. So when do these investments start to pay off and these banks start to show the return on those investments will be another interesting thing to kind of give to investors. It's a little easier, Tom, now, isn't it? Because so many investors around the world are really looking at many companies to show their AI strategy. And so that tech spend from JP Morgan, just beyond the competitive threat and to play a little bit of offense here, is very interesting.
Shonali, what is your sense of how deeply leaders, executives are thinking about some of the AI risks? Technologies, of course, like these can improve efficiencies and profit and margins, but you just think back to the flash crash of 2010 as a reminder that tech can trip you up as well.
Yeah, absolutely. They're thinking about not just AI risks, but remember, people don't talk about it nearly enough, the cyber risk that's under the surface here, and who they're working with, both in terms of an IP protection perspective as well as a cyber risk perspective. So there's a lot of things things to think about there. You think about how their clients are using AI as well, and you see how many limitations there are, Tom. This idea here that, sometimes the data inputs can be wrong, or even the market is too unpredictable to rely on AI completely. So I guess that is a positive picture for the job story, but to the point that you're making, there are risks, and the bankers are thinking about them all the time.
Certainly something that we're going to be keeping an eye on as we kind of see that marriage between tech and banking. Shirley Bassick, our global Wall Street correspondent, we thank you as always. Coming up on the program, retail earnings continue. Macy's due to report its first quarter results ahead of the U.S. market open. We're going to get a preview of what to expect next. Stick with us. This is Bloomberg.
Let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present it with a plan.
People ask me all the time, what is the key to being a really good investor? And I tell them, it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
So I think the main thing we did, which was not so easy, was to stick with our process. And then it kicked in big time in the last really 2 years.
This is Bloomberg's Surveillance Early Edition. I'm Tom McKenzie in London with Kriti Gupta in New York. A look at what's ahead today then. The ECB's account of the May meeting coming out at 7:30 a.m. Eastern time after we got that softer than expected inflation print. Then we get initial jobs claims in the US. That's at 8:30 a.m. Of course, after that shocker, the JOLTS number coming in much higher than expected, followed by US manufacturing data. And finally, Fed speak continuing with Philly Fed President Harker. That's at 1 p.m. Kriti.
And of course, we're also going to be watching the micro front on the docket today. Macy's earnings coming up shortly. The company reports its results ahead of the opening bell, and it could show a slight drop in consumer spending as shoppers start to cut back. Bloomberg's Madison Mills joins us now. Walk us through what we can expect here when it comes to one of the biggest consumer names in America.
Yeah, like you mentioned, Creedy, this could be the latest name added to the list of retailers showing us that consumer spending is finally starting to weaken a little bit because of those macro headwinds. We are expecting, and the average analyst estimate is a revenue decline of 5.5% in the latest quarter. Macy's hit a 52-week low yesterday, falling 39% since the end of the fourth quarter last year. Now, Bloomberg's second measure tracks retail data through transactions at these big retailers, and that also indicates that Macy's is having potentially a little bit of a slowdown, falling below the overall consensus, similar to what we saw at a Foot Locker, at a Target. But to get to some of the good news here, we did see other mass retailers like the owner of Michael Kors doing pretty well in their earnings, so that could be a boon for a Macy's. We're also seeing that they have really effective inventory management, and that could be good news for them. Some analysts are quoting that as a positive in their notes about Macy's in the last couple of days. So those are going to be the key things to watch heading into earnings at 8 a.m. today.
And Madison, as you round out the earnings that we've had through from some of these big retailers, what does it tell us about the strength of that sector in the US and, importantly, of course, the strength of the consumer?
Yeah, one of my sources put it really well. She said that you have to look so granular this earnings season. It's not just about the individual companies, it's also about the individual consumer. And looking ahead, it seems like consumer packaged goods companies and those consumer staples are going to be the ones that will perform well. We're looking at Procter & Gamble, Walmart, Pepsi, Coca-Cola. These are the firms that when I speak with analysts, they say they are looking ahead to a good rest of the year for them, particularly as we even head into 2024 and see some dollar weakness as well.
So we've talked about the macro headwinds. Let's talk about the tailwinds here. What does they have going for them right now?
Yeah, so as you know very well, Creedy, these freight costs coming down are potentially a huge plus side for these retailers. And that's something that particularly stands out for a company like Macy's that, again, has been able to control their inventory and make sure that they're managing that well. Macy's is known for having really good data analytics that helps them to really accurately suss out exactly what consumers are going to be purchasing. Another tailwind is luxury. We saw that Ralph Lauren had really good earnings because their consumer is able to stomach a little bit of a price hike. They rose prices by 12% over the past year, and that was able to get them through this tough earnings season despite some of those macro headwinds because their consumer is able to stomach those costs. So we could see Macy's brand like a Bloomingdale's and Bluemercury really allowing them to maintain their strength this earnings season.
Something we'll be keeping an eye on, of course, Bloomberg's Mass and Mills all over that story. Thank you for waking up early for us. We always appreciate it. Let's look at some of the stocks we're watching in the pre-market. Of course, Macy's going to be top of mind. The earnings expected to usually come around at 8 a.m. New York time. You are seeing those shares higher. Some optimism, as Maddie just pointed out, baked into those markets, higher by about 4.3%. And that's going to be a really important consumer story, just given that they do have that extreme exposure to the luxury sector as well. But of course, we're going to keep an eye on tech as well. Remember, NVIDIA retreating from that $1 trillion mark, but potentially marching back in that direction, higher by 1.4% this morning. What's interesting is that Intel is also catching a little bit of a bid. The CFO coming after the bell last night and saying their second quarter sales are near the upper end of their range. NVIDIA also saying they may be partnering with Intel when it comes to some of their chip technology. On the other hand, C3 AI came out this after the bell yesterday as well, dropping by 20%. Growth concerns there when it comes to the AI story, Tom. So already seeing a little bit of nuance with how this market interprets that story. And of course, let's talk about the big heavyweight when it comes to the S&P 500 and the Dow. Salesforce falling this morning to the tune of 5.5%. We're seeing those shares trade at about $211.20. Those growth concerns really taking a hit. And remember, Salesforce is extremely exposed to the business investment story, Tom. So it's a little scary to start to see a lot of the corporates pull back on that kind of spending.
Yeah, the focus on profit versus growth for Salesforce a concern for some. Here in Europe, a snapback in terms of sentiment after 3 days of losses. You're seeing gains of 0.7%. Every single sector now, bar one, is in the green, led by media, autos and banks. Some of that data out of Europe looking a little bit more positive, and the China read across as well. That is it for the early edition. Surveillance is ahead with Bill Dudley, of course, former president of the New York Fed, among others. This is Bloomberg.
politics,
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
and Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee
The
Langs.
door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news
This is such an important economic issue.
He's no longer trying to run away from
That
it.
really blew some minds.
insight,
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
and analysis.
I think your audience would get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important. This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays.
Demand is starting to slow. We're seeing that way back in the supply chain.
The real question is, are investors pricing in growth opportunities over the next 5 years?
This has been a very slow-moving economy and market. If you have super high conviction right now, you're not paying attention.
What we've seen so far seems more consistent with a soft landing in the labor market.
We still think we're going to be in recession by the end of the year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Welcome to Wall Street, where a month feels like a year. From New York City this morning, good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio, alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. As we close out May and kick off June, your equity market just about positive by 0.2%. Shout out to Jim Reed at Deutsche Bank this morning. Really enjoyed that note. TK reminding us that First Republic was taken out by JP Morgan in May. I'd totally forgotten that.
Yes.
That felt like months and months and months ago, TK.
We had a couple comments yesterday that it's not over. I mean, I thought Bob Michael yesterday of JP Morgan was just riveting in his view on this, and that the deposit dynamics are still there, and that's a huge story for June and frankly into the summer. We've got to remind ourselves, June 1, and it's simple. There's a wall of economic data today. John, you love the ISMs, and we've got an early jobs Friday tomorrow.
Yesterday, whipsawed three different ways. We had the Chicago PMI, ugly, okay, deal with that. JOLTS data, job openings, surging, had to deal with that. And then Fed speakers came out. Whatever you do, don't call it a pause. It upsets them. It's a skip, Brammer. It's a skip.
Okay, so this sort of whipsawing action, I couldn't get my head around. The JOLTS data, I thought, okay, well, this shows a hot labor market. The ISM, okay, yeah, we've got a manufacturing recession that's not great. And then Fed officials come out, and what does data dependency mean? And I know that you've been on this all year long, but basically the data doesn't matter. If we get a really hot jobs report tomorrow, do we really get a difference, or are they going to do a pause, skip, whatever you want to call it, this month?
What did Governor Jefferson say yesterday? Something like, if we do pause, we mean skip. And that skip would mean that we could hike again. But it doesn't necessarily mean that it's a peak rate at the Federal Reserve. Do you think the market's going to see it that way?
It's what the market is actually saying this morning. Right now, what you're seeing baked into the Fed futures markets are basically there's going to be no hike this month, and then there's going to be a 25 basis point hike in July, and then it will be cuts later in the year.
Barclays say hike in June still. Data's going to push them over the line. Citi, Andrew Hollenhorst talked a lot about Andrew. He thinks hike again. hike again in 2 weeks, and then hike again in July.
I'm way more interested in China. I thought yesterday's China dynamic was far more important.
Well, thanks for listening to us, but carry on, please.
I don't agree with any of this Fed parlor stuff.
Oh, okay.
I think it's just a modern invention of the futures market, and the answer is skip, pause. What's Beijing going to do? Are they going to skip or pause here with an imploding economy? Zero Hedge featured Bloomberg's George Lee of our markets team in their summary of all the research and guesstimates on China. Guess what? Jobs report Friday. China opens Sunday evening, New York time.
They can't reopen twice, can they? That's the problem. Where's the growth engine going to come from?
Yeah.
Where's the challenge to the dollar strength we've seen over the last few weeks going to come from?
And then what does that mean for Europe? I mean, honestly, these are all of the stories that have been hard to get a handle on. And I've got to say, going back to where you began, this idea that a month feels like a year. Think of all of the narratives that we have gone through each week. And here we are halfway through at an inflection point, maybe, with the Fed showing that clearly the risks right now are to the downside, and they're aware of that. So again, we have to wonder, what are they looking for to give them a sense that they should be hiking rates?
The last 3 minutes felt like a year. Let's get to the price action. Equity futures on the S&P 500 positive by 0.2%. China in the bond market yields higher by 3 basis points, 367.52. Why do you never listen to us, TK?
I don't believe. I think the media parlor game and all the Fed speak. It's not that it's a waste of time. It's just a complete slave to the data. The most important data, I guess, is the wall of data today. ADP, does it matter? I don't think so. Claims. And then, of course, tomorrow's data onto the inflation data is far more important.
Is that why you stopped reading the Fed speeches?
Yeah, some and several of us have stopped reading it.
You can tell. Bramo?
Okay, we're talking about the data dump. Let's just give a sense of what we are expecting. Jobless claims at 8:30 a.m. Very interesting to see whether they do continue to tick up, especially after the JOLTS data yesterday. ISM manufacturing PMIs at 10 a.m. I'm very curious to see whether that reflects the Dallas Fed data yesterday. We also are hearing from Philly Fed President Patrick Harker, which will be interesting to see at 1 p.m. whether he sort of double downs on the skip, pause, whatever you want to call it, this month. Today, we have banking executives speaking at the Bernstein Annual Strategic Decisions Conference. This will be interesting, especially in light of the acquisition that we've all forgotten about, First Republic. We hear from John Waldron of Goldman Sachs, Bill Demchak of PNC, which actually might be the most interesting to me, simply because of the regional banking issues, and Brian Moynihan of Bank of America. And today, retail earnings before the bell, Macy's, Land's End, Dollar General. Very curious to see particularly the lower end, and Lululemon after the market. I like Lululemon.
I know. There's nothing wrong with that.
I know.
Why do you make it sound like it's a secret you can't talk about?
I mean, I don't know. Like, I'm just explaining that I like the casual trend, and I know it's on its way out, and I am curious to see whether that's reflected in the earnings.
Is it on its way out?
I don't know. I mean, that's what I hear from different people.
I'm trying to push it out of Midtown.
I know. You've been on a single-handed crusade to get rid of it.
Sell in May and go away. SPX flat.
You really aren't
Dow,
listening to us, are you?
-4. NASDAQ, as you mentioned yesterday.
Up 8%.
Up 8%. 500 basis point up over equally weighted NASDAQ.
Any comments on
never
Lulu?
Seen that. No comments on
Okay. Russ Kostick joins us now.
I've never been in a Lulu.
BlackRock Global Allocation Fund Portfolio Manager.
Yeah, I should.
Russ, the scores are in. Tom mentioned them. The S&P 500, marginal gains for the month of May. The NASDAQ still absolutely flying. You've been very clear every time we've caught up, consistently adding equity risk. Now, Russ, can you tell us where you've been adding that risk?
Absolutely. Good morning. So, Jonathan, I think as you might remember, we were underweight in the fund for really most of 22. Thankfully, that proved to be the right thing. We've been adding back, and the thesis is fairly simple. The economy has proven remarkably resilient. We've spoken about the reasons, the labor market, excess consumer spending. And the reality is, as we saw as we had the Q1 earnings results, corporate America is actually doing all right. And in an environment in which nominal GDP is likely to hold up a lot better than many of us thought 6 months ago, we think there's still an opportunity to add back on weakness. What we've been focusing on is what I'd call stable growth, high quality growth. In other words, we're not looking at the unprofitable companies that were ripping in late 2020. We're looking at companies that can generate earnings consistency, margin consistency, low leverage, that are very profitable. Right. And that's where we've really been focusing the ad so far this year.
Are there a lot of those companies out there? I mean, I know you got a fancy computer screen. Maybe you're doing it off your iPhone. But, Russell, there are a lot of companies out there that give you that quality free cash flow growth.
There are actually. Clearly the market's been focused on one thing for the last few months, and that's been tech. And parts of tech that are most levered to AI. And there are a lot of themes there that actually we like long term, but there are other parts of the market. It's not simply tech that evidence these characteristics. You can talk about defense companies, luxury good manufacturers, parts of industrial. So we are finding that there are a lot of companies, many of them US based, that are giving you that quality cash flow that's likely to hold up, even if we do see some slowing in the back half of the year, which is, let's be honest, the most likely scenario.
My favorite part about your note, Russ, is that it sounds risk on, right? This idea we've been consistently adding to equity risk. Okay, so you're bullish, you see opportunity, and then you go on to read the rest of it. The economy is decelerating. We expect there to be an increase in defaults. We're going to have issues. Perhaps recession's not a foregone conclusion. But at this point, is there sort of an interesting conclusion here that in some ways, equity risk in some of these companies with all of the caveats is a safer bet than certain slices of the bond market?
I think that's a really good way of putting it. And just to be clear, we've been adding equity risk back, but we were adding it from a very underweight position last year. So it's not a back up the truck moment, but it is a moment to have that exposure. And I think the point you made is a very good one. You think about what is done well in this environment where you've had a mini banking crisis. You've had concerns about the debt ceiling. The companies that people have faith in, that are going to produce solid earnings regardless of those outcomes. And again, if you have a drawdown in the market, you're going to see these names take a hit. But long term, 6, 12, 18 months out, I think these are places not so much to hide, but to weather what is likely to be a slowdown and what is still likely to be, an environment where there's some uncertainty around how far the Fed is going to go.
And we were talking about this yesterday, about whether bonds will still provide the offset, or actually in some ways, if some of these cash flow stocks are kind of the new offset at a moment where 60-40 doesn't necessarily have the same automatic dependency.
Yeah. Well, 60-40, I don't think 60-40 is quite as dead as everyone made out to be last year. And there have been periods this year where that bond worked very well as a hedge. In the aftermath of SVB, that stock bond correlation, after being very positive in 2022, flipped back to negative. Having said that, I do agree that it's going to be a little bit more varied. In other words, if we get the bad inflation print, if the Fed is going to talk about going further, you're going to see that stock bond correlation flip more than it did for most of the last 10 years. So it's really a matter of both. Having some good high quality carry in the portfolio and having these companies that evidence quality. Now, all the debate about growth and value, this is the attribute we think is most important in a portfolio right now.
Russ, you just seem like you're in the zone right now and things are going right. I'm just reading this note. We have also added a small gold position as a tail hedge. Even your hedges are working with equities flying. What's the gold position about, Russ?
The gold position is always a tough one. And, we've had gold back in 2020. We took it out last year when the dollar and real rates are ripping. The gold does a couple of things. One, in an environment, if we start seeing the back half of the year, real rates are declining, gold responds well. The dollar looks to have peaked. That's another tailwind for gold. But the other factor, which we've been living with for much of the last 6 months, whether we're talking about the uncertainty over China, the ongoing conflict in the Ukraine, and the debt ceiling, one thing gold tends to work well as is a tail hedge when people are really worried about the wheels coming off.
Interesting. Russ, thank you. Russ Kostruck there of BlackRock. Gold up nicely year to date by 7 or 8%, TK. You've been looking at that, I know.
Oh, I always look at it. Dennis Gartman gave us a briefing yesterday. Obviously, he is in gold. He's always in gold. But what's fascinating off the Gartman call is gold in euros. Gold in yen. It's an extraordinary performance against yen. It's on edge of moonshot.
We haven't talked about the debt ceiling debate yet, have we? 314 to 117 through the House with ease. Speaker McCarthy calling it a bit of a win. You'd expect that. One key caveat, I think, to that win. More Democrats voted for this than Republicans. Ramo.
This is going to be a hard sell in the political theater sphere, which we're going to be hearing a lot of.
Next step to push this one through the Senate and get it to the president's desk. Coming up next, Heidi Kribo-Rediker of the Council on Foreign Relations from New York City as we kick off the month of June. Welcome to the program. Equity futures positive by 0.2%.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo.
Iran has reinstalled monitoring equipment and boosted its cooperation with international inspectors, even as its engineers added stock to stockpiles of uranium. The findings by the IAEA in its quarterly report reduces the likelihood Iran will face censure when diplomats discuss its nuclear program next week. Around 50 Credit Suisse bankers are suing Switzerland's financial regulator for rendering their bonuses worthless. A Swiss federal court spokesman says they're suing over the write-down of so-called contingent capital awards. The bonuses were based on AT1 bonds, which were wiped out in the emergency rescue of Credit Suisse. NVIDIA's CEO is said to be heading to China later this month to meet with tech executives in the world's biggest chip market. A source says companies on his itinerary include gaming leader Tencent and TikTok owner ByteDance. The CEO's first China trip in years will come as the U.S. tries to curb Beijing's access to leading-edge chip technology. The U.S. House has passed the debt limit deal struck by Speaker Kevin McCarthy and President Joe Biden to avert a catastrophic U.S. default. Lawmakers from both parties joined to approve the bill 314 to 117 Wednesday night.
There's been a very good vote in the House of Representatives. I hope we can move the bill quickly here in the Senate and bring it to the President's desk as soon as possible.
The compromise deal drew opposition from the flanks of both parties. Objections from conservatives could force days of debate in the upper house. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
London and Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
The jobs report has not been good news for the Fed.
3.4% unemployment.
That's not the picture Jay Powell thought he'd be looking at.
It really signals an employment market that's chugging along
miles from where the chairman of the Fed wants to be.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
It hasn't been a widespread job loss.
The tightening is yet to show up.
Fed's not going to quit until the labor market quits.
The May Jobs Report, Friday on Bloomberg Television and Radio.
Tonight, we all made history, because this is the biggest cut in savings this Congress has ever voted for.
There's been a very good vote in the House of Representatives. I hope we can move the bill quickly here in the Senate and bring it to the president's desk as soon as possible.
House Speaker Kevin McCarthy, Senate Majority Leader Chuck Schumer passing a deal with ease through the House. Lawmakers from both parties voting for that debt limit deal at 314 to 117. As Senator Schumer pointed out, it's on to the Senate from here, potentially a vote on that Friday into the weekend, and then onto the president's desk. And Tom, hopefully we can all move on.
Yes, I don't think it's that easy. I think the Senate, Greg Villiers features it this morning. He thinks the Senate's going to be sport because of two senators, and we can go into that as they slow it down and block it up. Margot Sanger-Katz with a brilliant article that both Lisa and I saw in the New York Times, and I love this phrase, John. It's Thursday. It's not Claims Thursday. It's agreed upon adjustments Thursday.
Do you want to explain that?
Beautiful chart. Here's where we are now. Boy, are we saving a lot of money. Let's pull that puppy back over 24 months. And the answer is, Lisa, to me, you know, the Sanger-Katz Parlapiano research in the New York Times, which I'm sure CBO will catch up on, is we're doing nothing here. We're spinning wheels.
Well, but that's exactly my conclusion. Basically, let's agree to disagree on exactly how to deal with the big problems and basically come up with window dressing to put on top so we don't actually have to
Because 2 years out, we're going to readjust it with sidecar deals, John. I mean, it's almost like the British government.
Not quite. At least they agree on a budget and push it through. This is the new world, isn't it? And it's been going on for a long, long time. You manufacture a crisis and you negotiate the budget. We're going to see this act again and again and again.
Bring the banner up again on radio. I'm sorry. It's just too good to be true. Thank you, Margot, for this. It's agreed upon adjustments Thursday. They agreed upon adjustments down the road. And that's it. I mean, there's nothing really else to say. We're gonna go on right now from the budget. Try to move away from that. Heidi Krebo-Redeker is with a senior fellow, Council on Foreign Relations, really writing as much as she can on what we were talking about yesterday and continue today with Rika Renminbi, and that is China. Heidi, thank you so much for joining. Is the China slowdown for real?
So I think, you have a lag in data and some revisions, and I don't know if we really understand if the data coming out of China is accurate, in part because they're coming out of a very, significant COVID lockdown. So just think back to when we were publishing our data and revising.
A lot of the doubt about China will be solved by electric vehicles and their growth. Discuss that export might we're not factoring in.
So I just got back from Europe, and China was a key part of all the conversations because of the U.S. EU Trade and Technology Council. We had Secretaries Blinken and Raimondo there, USTR, Tai. We saw kind of a focus just on the main bone of contention, which is that the subsidies for EVs in the U.S. are not offered to EU automakers because of the China components to the vehicles, but. I think that you have this muscle memory of trade negotiators of going after, what's happening between the U.S. and the EU, and at the same time, you have China exporting more electric vehicles, more autos that are Chinese autos. Right. Just a striking uptick in particularly EVs.
Lisa, there's the analysis, and the further analysis is whoever's out on Twitter trying to figure out when Mr. Musk's airplane leaves Shanghai.
Well, yeah,
that's happened in the last 24 hours.
Exactly. I know that we want to move on from the debt ceiling, but I kind of can't yet, and I have to sort of parry into the conversation that I'm sure, Heidi, you are having over in Europe, which is what are these subsidies going to look like, particularly when it comes to the recent tech-driven investments that the U.S. were promising to make. Did anything really change? Was any of the heft of some of those programs removed from this agreement that we got from the debt ceiling, or was it basically the adjustments that kind of came in after the fact and made sure it was all okay?
So, one of the great things about being overseas is that you really didn't have a lot of focus on the debt ceiling, as opposed to like living at 24/7 here. The focus on U.S. politics was much more driven by Trump. and looking at the numbers and the upcoming election and whatever deals are being struck right now between the U.S. and the EU, are they up for grabs if Trump were to win the presidency in the next go around? So I think, that's Trump played a prominent role, and concerns in whether or not there was a need for Europe to hedge in its negotiations, not for all countries, but for some countries. And I think that's why we didn't see consensus, the same kind of consensus that we saw at the G7 and the Quad meetings in the past 2 weeks, when we with our negotiators in Europe this week.
What does that mean with respect to U.S.-European alliance, with respect to China, with respect to some of these bigger issues, if there is sort of a pretty tepid receival of the United States with sort of ambiguous leadership?
So I think that the U.S. seems to be very much in line, and the Biden administration's in line with the EU Commission. It's just that there are 27 different member countries, and all of them are sort of playing out how they want to, how they perceive weakness versus strength and need to hedge. And because you have to have unanimity, it was in full display, and particularly around China this week, that you just don't have it in the EU, where you do, I think, really in Asia to a larger extent, vis-a-vis China.
I'll be less diplomatic. You have the Commission, and then you have Macron. And that's why things are confusing in Europe right now. And Lisa, that's been the story, hasn't it, for the last couple of months?
Well, yes. And Emmanuel Macron is like, hey, we're going to strike a deal with you. Go, China. Yay, right. Let's go to Beijing and the rest of Europe. It's like, what are you doing? At the same time, I wonder how much reticence there is to really partner with the U.S. in light of some of the recent subsidies, in light of some of the potential volatility. You think this is just a Macron issue?
Oh, the reports I hear about how well-liked Macron is at the G7 is just kind of,
well-liked.
Or how
yeah, I was about to say.
Less liked, he's liked.
Right. I imagine that's the case.
That's me trying to be diplomatic. Heidi, thank you. Wonderful, as always, to hear from you. Heidi Kriebe-Rediker there of the Council on Foreign Relations. Here's one for you. The relations around this. There's an OPEC Plus meeting into the weekend. This is from the FT, from Bloomberg, from a whole host of media organizations. Reuters, Bloomberg, Dow Jones banned from attending these meetings. That's got everybody's attention going into this.
Reportedly, there are some potential news outlets that have been invited, like the New York Times and CNBC, but it's unclear whether they will go. That is what I'm hearing anecdotally. The bigger question is, what are they doing? This is the first meeting where they're meeting in person. There are likely going to be output cuts that are going to be implemented in order to get the price up. What are they trying to basically message here?
Just before we went to air, Edward Morse published at Citigroup.
What did he say?
And the summary of it is simple. OPEC Plus and its, quote, market power. It was an exceptionally diffuse note by someone who has nailed the price of a barrel of crude. Ed Morse, more than anyone I know, has gotten this call right. And he says they're struggling with what is their market power. And I wonder if that's where this blockage of news organizations comes from, is they're petrified about how to get their message coherent, how to get their message out without the journalism that goes into questioning policy and the rest.
Well, to be fair also, OPEC Plus and the countries that make up that cartel, not exactly known, many of them, for their free and open press.
Absolutely.
In their own countries.
Yeah. Well, and it's not like the media outlets aren't going to go and aren't going to speak to people who are in the room. So again, what are they playing at? Why is this? What's the signal here?
You can see it, can't you? Some of the media organizations on the outside just kind of texting the delegates on the inside.
You know, the phrase here is
the stories. Oh yeah, sure.
I mean, come on.
The key phrase here is simple. It's Javier Blas's fault.
Javier Blas is coming up in about 20 minutes. Looking forward to catching up with Javier. Crude right now, 68 on WTI, totally unchanged. To kick off the month of June, equities slightly positive. From New York, this is Bloomberg.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
The names that move markets are on Bloomberg.
The regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics. What I see is a banking system that overall is well capitalized, still has very solid earnings, but we're monitoring the situation very, very carefully.
Nobody covers business like Bloomberg, your global business authority.
Just about closed out May with a monthly gain on the S&P 500. A very marginal third month of gains on the S&P. Nothing marginal about it on the Nasdaq 100, up by almost 8% to close out the month. On the session right now, just about positive by 0.1%. You can thank the likes of NVIDIA for that. NVIDIA through May added almost $250 billion to the market cap of that company, Tom. How impressive is that? 250 billion US dollars.
I'm going to suggest we've never seen it, but I think a lot of other things lifted up as well. What's interesting is 1 year trailing, sell in May the last time around, NASDAQ up 7%, SPX flat essentially, and the Dow flat, a little bit negative as well. So it's been a 1 year churn here around all the emotion we're covering every day.
Yields are up through last month. They look like this right now. 2-year, 10-year, 30-year, higher again to kick off June by 4 basis points. Trim that monthly advance in yesterday's session. Right now, 444.64. So on the month, up something like 40 basis points on a 2-year as we started to price out cuts. I think pricing out cuts is the right way to put this as opposed to pricing in hikes. Pricing out those cuts, though, happen to drive some dollar strength with some real weakness in the data in China, in Europe. In the single market, looking at the single currency, the euro against the dollar shaping up as follows. Euro dollar 107.09, just reclaiming that 107 handle in the last hour or so. But on that currency pair, down about 3% on that currency pair through last month in May. That's the worst month this year. In fact, it's the worst month going all the way back to April of last year, Tom.
Can we all agree it's a surprise of the year? I think everybody was looking weak dollar.
There's been many.
There's been many. But
doubts about tech ripped.
Yeah.
Doubts about the Fed. They may hike again. Doubts about the dollar. Dollar's stronger, Lisa.
Surprise of the week, which is basically a year when it comes to 2023.
I take your pick. I remember when everyone lined up saying buy the banks. Do you remember that?
Oh, yeah, that was good. That was good. January,
The
February.
banks didn't work out either. Had a lot of Fed speak recently. President Harker on tap ahead of the quiet period. Fed Governor Philip Jefferson signaling a pause may be in store with more hikes to follow. A decision to hold our policy rate constant at a coming meeting should not be interpreted to mean that we have reached the peak rate for this cycle. Skipping a rate hike at a coming meeting would allow the committee to see more data before making decisions about the extent of additional policy firming. He's sounding more and more like a Fed vice chair, getting a committee together. Look, there is consensus on the committee right now. It's on two things. One, no cuts. And two, if we do skip June, we're not calling it a pause. So you can just see how the language is shifting. And if you wanted to find consensus on the committee, if that decision was today, you can see where Chairman Powell would find that consensus.
But the answer is what they're all on the same page on is they're all looking at the data. I mean, they are slaves to the data right now. And the labor is we had Randy Krasner on from a couple of weeks ago, and the answer is unemployment, jobs hasn't broken.
Elisa made this point earlier, though, Tom, and I think it's a really important one. Some people might interpret the comments of yesterday as de-emphasizing the data that comes out tomorrow.
Yeah, fair.
De-emphasizing CPI. And really emphasizing that we can skip June, wait and look at what the data that comes together ahead of July.
Can we get existential?
If you want to, sure.
What if the Fed does in a quiet period and they get in the quiet car in the Excel? What happens? It's like Stephen Wright, the comedian.
1-800 Wall Street Journal and plant a story again. Say we're hiking because CPI was too hot.
They can't. They do it by text because it's the quiet.
What do they call that? Nikki Leaks. Yeah. Over at Wall Street.
That was a Stephen Wright moment there. Quiet people on the quiet car. Let us move forward now, and it is our immense pleasure to speak with Alan Ruskin, Chief International Strategist at Deutsche Bank. His notes are absolutely fabulous. You can get them, of course, through Deutsche Bank. Alan Ruskin, you have an absolutely brilliant paragraph on M2 dynamics and nominal GDP. Is the surprise of the next 12 months forward that we have sustained nominal GDP because of sticky inflation?
It's a little bit like that, Tom. I think we're, going to see, for example, data today which shows that productivity was extremely weak in Q1, but not just Q1, on a trend basis, it seems. And that weakness in productivity translates to high unit labor costs, which is sort of stagflationary. And output, we know, is relatively weak relative to employment. That's part of the weak productivity story. So it all adds up to nominal GDP doing an awful lot better than real GDP at this point. Some of this, I think, is just this natural overhang from the M2 growth. We had, something like 30% M2 growth above trend a year ago. That's down to about 20% overhang, thanks to weaker M2 growth that we've seen more recently. But still, I think that's really propping up the nominal numbers. But monetary policy and money supply is a veil. It doesn't ultimately pay you to print money. It doesn't generate real GDP growth.
The real GDP growth is the recession game. Your colleagues have been brilliant on this. Matt Luzetti has arguably the single best recession delay call of the last 18 months. Reframe that now. I'm not saying agree with young Luzetti, but at least frame out the Ruskin recession to come.
Yeah, I've always been of opinion that given the overshoot on inflation, even if we have a mild recession, I would still cast that as potentially a soft landing sort of scenario. I know that's semantics in a sense, but I think we're still pretty much on track. But we do need to see some weakening in the labor market. And of course, everything we saw from the openings data yesterday suggests that employment will remain relatively resilient. So you've got this weird dynamic again, whereby employment is relatively strong compared to output. And particularly, I think we're seeing weakness in the manufacturing sector worldwide. So there's another story there as well. But I would say that we're still on track for something which skirts recession / shallow recession, but it's not looking like a deep recession unless we get some sort of nonlinear event like the banking sector crisis sort of really taking hold and a proper credit crunch, which we have not actually seen as yet.
You mentioned manufacturing, Alan. That distinction, I think, is so important. Manufacturing PMIs worldwide, Europe, China, south of 50, contraction rate, throw in the United States, pretty ugly there. It screams rate cuts in some places. Then you look at services, Alan, which make up the bulk of some of these economies, still pretty robust. Alan, the surprise of the last month or so has just been the breakdown in another consensus trade. Dollar weakness to dollar strength. Alan, as you look at things right now, have we broken that trend? Is this something new? And if it isn't, where does that new engine of dollar weakness come from?
I think it's deferred dollar weakness. The whole idea of a divergence trade that worked against the dollar, whereby, Europe, if not outperforming, at least the ECB was hiking whilst the Fed was on hold. And China was obviously, sort of reopening and the strength that we would expect there, or what we did expect there. A lot of that just hasn't materialized. In fact, if anything, the U.S. has been more resilient than anticipated. And, consequently, I think what you're seeing on the exchange rate is very much reflective of what you've seen on interest rate spreads. So the interest rate spread story is just taking its cue from this relative growth story. I think right now, it depends on where the Fed goes. For example, if they hike in June. It seems less likely after yesterday's Fed comments, but if they hiked in June, I think we'd be down at 105 on euro dollar. If they don't hike in June, we can trade here in the sort of 107 sort of area for the time being as far as euro dollar is concerned.
Alan, you had this really interesting point in your latest note where you basically were saying there's a little risk of over-tightening. That does not seem to be the theme that we're hearing in the Fed speak that's been coming out every day, day after day. Can you explain that, what that means as to where policy should be, where it will likely be, and what that means for longer-term inflation?
Yeah, I mean, I think just look at your financial, conditions indicators. We all have our own numbers, but if you look at the Bloomberg numbers, for example, you look at, say, 6-month financial conditions, 12-month financial conditions. If anything, they've eased rather than tightened, which is truly extraordinary. So the tightening needs to come from something like the credit side. You're not seeing it in terms of credit prices particularly. Maybe, issuance markets are tight and closing up. But in general, you're not seeing this kind of non-linear event that I think would have tightened financial conditions sufficiently to really risk over-tightening. Now, maybe the Federal Reserve, which has, some distinct advantages in this sphere and knows a little bit more on the banking sector side, it's clear that you do need additional consolidation over the longer term.